Good evening, everyone. I'm Seattle Bakkar, moderator of this VCM. We are delighted to welcome you all in the 32nd VCM of the series Beating the Monday Blues, being organized by Continuing Professional Education Committee of ICAI. It is my pleasure to be a moderator for this session on VCM on professional opportunities for CAs in UAE taxation and Indian insurance sector. In a short while, we will start this VCM. I would like to apprise you about CPE committee. The increasing globalization, continuing developments in the field of finance, and frequent changes in the world economic order have posed numerous challenges before the accounting profession worldwide. These challenges have significant implications on the growth and development of our profession and society as a whole. It is indeed the responsibility of the professional bodies to provide members with adequate facilities and opportunities to meet the challenges thrown by the dynamic environment, skills, and professional values. With this vision, the CPE Committee of ICAI has been organizing a number of programs with the help of our program organizing units. The program for this evening is as follows. We have two sessions of 1.5 hours each, and the topics are opportunities for Indian CAs in UAE and professional opportunities in insurance industry. Now, I would request Chairperson of Jabalpur branch of CIRC of ICI, CA Madhu Agarwalji, for her address. CA Madhu Agarwalji, please welcome.
Thank you, CA Dilbag Kaurji. Good afternoon. Namaskar to all the members present. Respected Kimisha Soni Ma'am, Chairperson CPE Committee, CA Charanjit Singh Nanda ji, Vice Chairman CPE Committee, Ajit Nath Tiwari ji, our learned and knowledgeable speaker for today, CA Pushkar Kundra ji and CA PS Prabhakar ji. Welcome to the knowledge enhancing session and all the participants present today. Learning should never stop, and the VCM which are being organized by the CPE Learning Series is the best to quench the thirst of knowledge. Here I would like to share with all of you that Jabalpur being a small branch, we are always short of experienced and knowledgeable speakers on various topics. और जैसे कि कहते हैं ना कि हर सिक्के के दो पहलू होते हैं. So because of COVID and the world going virtual, we with the help of CPE committees, because now we are doing virtual programs, and so the CPE committee was there to help us, and they are providing us with speakers not only from all over India, but out of India also. And we, again, being a small branch, there were few topics which we were wanted to do CPE on. Our members were wanting to have knowledge on few topics, but again, when we were offline, we were conducting physical VCMs. It was being difficult for us to conduct the VCMs because we did not have experienced faculties for the same. But with the help of CPE committee now, we have overcome this disadvantage, and we are going through, all the topics which we were wanting to do previously. And I'm very happy to share that under the able guidance of CPE Chairman Kimisha Ma'am, we have done approximately 74 CPERs during the year 21-22, and we are just going on, and the numbers would increase, obviously. And in the end, I'm just hoping that all the participants will gain maximum from this CPE. Thank you.
Thank you, ma'am. Since you have used Hindi, I will not hesitate saying this. सपने उन्हीं के साकार होते हैं जिनके हौसलों में जान होती है. With these words, I would love to introduce Vice Chairman CPE CACS Nanda ji, Shri CS Charanjot Singh Nanda ji, Vice Chairman CPE Committee, is the Chairman of Internal Audit Standards Board and Committee of Management Accounting and Vice Chairman of CPE Committee. He is very experienced practicing chartered accountant and is practicing in different fields. With the commitment to serve the profession, he has been a member of SEBI, SAFA Committee, and IRDA's Steering Committee. An avid speaker, he shares his knowledge throughout India and abroad at various events organized by ICI and other reputed institutes. Please welcome C.S. Nanda ji for the welcome address. Thank you.
Thanks a lot, Dilbag, for introducing me. Madam Madhu Agarwal, Mr. Ajit Tiwari, the Secretary. I also see CA P.S. Prabhakar, the Speaker of the Day, and my very dear friend, Mr. Devang, the Technical Support, Madam Sreja Rajneesh, CA Pushkar Kundra, like my son who has joined from Dubai, and all people who have gone home, come here to go home more enlightened, putting at rest all the doubts that may have arisen related to the subject. Ladies and gentlemen, I am in Chennai and we had a GST meeting, but when Ajiji told me that we are starting this program, I thought it fit to come and address at least for 2-3 minutes. I would like to very candidly put that your CP committee is passionately involved in doing programs which are contemporary in nature and are called for the members across the country. Today, I like to share a bit of history. We started doing this program called Beating Monday Blues. And today is the last program because the council terms comes to an end on 12th February. And today is the Monday and the last Monday because next Monday would be on 14th February. Therefore, this is the last program. And I want to tell you that the response to these programs were very great. At times we had more than 6,000-7,000 members also joining in. And the member who continually join are giving their feedbacks and advising us on the topics which they may need. I want to tell one thing very seriously, that our profession, which was set up an Act of Parliament way back on 1st July 1949, when the most important document to the democracy, the Constitution, was not adopted, clearly signifies the fact that the government has put a lot of reliance on us. So, ladies and gentlemen, honing of our technical skills is very important because our impetus and technical knowledge will ensure that the clients go home more enlightened, and more importantly, we are able to serve them more effectively. Ladies and gentlemen, the only message I would like to give you was of Dr. S. Radhakrishnan, the first president of Free India. He said that it is up to you to fly as high as you intend to, but keep your feet deeply embedded to the earth below. And if you say this by a couplet in Urdu, it would be, आसमां पे किसी के ठिकाने नहीं होते, आसमां पे किसी के ठिकाने नहीं होते, जो जमीन के नहीं होते वो कहीं के नहीं होते. We have to remain embedded to the ground. The ground realities have to be known, and particularly for a profession like us, where every movement is to bail this economy, every movement is to help the clients, help this great country. Our involvement at root level is very, very important. CP is doing a yeoman task, and we are passionately trying to give you the best of the speakers so that all issues related to a particular subject are immediately settled. So, not speaking much, I have two of my great speakers, Mr. Kundra and Mr. Prabhakar, both my very old friends. I and Mr. Prabhakar know each here for close to 25 years, and I know his level of involvement in spite of being so busy in budget programs. He very candidly agreed to come and speak on the insurance sector. Even Mr. Kundra, who is in Dubai, he was awfully busy, but I said no, I want the opportunities for chartered accountants in UAE, and he immediately agreed to it. So I'm thankful to both of them. I am thankful to Dilbag also. I'm thankful to Madam Madhu Agarwal, Ajit, and all people who are working to make this conference a great success. I wish this conference a great success. Happy learning and goodbye. Thank you. Thank you so much.
Thank you, sir, for the enlightenment. Keep your feet deeply embedded. This was, so sir has told us that this is probably last program of this series, as the council year will end 21-22 on 12th Feb. So we are very blessed to have CAPS Prabhakarji with us for today. Thank you, sir, for sparing so much of valuable time for us. CACS Prabhakarji is a chartered accountant. He has over 40 years of post-qualification experience, out of which 11 years in Indian public sector insurance industry. 7 years in Gulf Insurance
Dilbag ji,
and Investment Company as Group CFO. And
Madam
presently,
Dilbag ji,
yes, sir.
we had the first session with CA Pushkar Kundra ji.
Oh, sorry, sir. Very sorry. Very sorry.
No, it's all right. It's all right. It's all right. Just please
Okay.
continue.
No issue,
Introducing-
plus please introduce Mr. Prabhakar. Please introduce him. No issues.
Thank you, sir. I was about to do it. So, continuing with Mr. Prabhakar, he was a member in IRDA Standing Committee on Accounting Issues. He have been invited as a speaker in many forums, including ICSI, LABA, Lions Club, Revenue Bar Association, etc. He is the President, Society of Auditors, Chennai, an organization of 90 years standing, have been a prolific writer on various issues concerning profession on topics such as insurance, IFRS, taxation, multinational accounting firms, etc. Now coming to Mr. CA Pushkar Kundraji, he is a chartered accountant. He is senior manager and is responsible for indirect tax with specialization in insurance, healthcare, logistics, and education sectors. He is prolific speaker and trainer and has conducted more than 500 deliberations on various topics of GST. He has over 8 years of indirect tax experience, providing holistic support from transition to implementation in India, UAE, and Oman. He also excels at an advisory role owing to his ingenuity and flair for perceiving the legal nuances and market conditions. He is a regular speaker at various forums on tax and has delivered various technical trainings on VAT in the GCC. Please welcome CA Pushkar Kundraji. It is to inform you all that more than 1,700 participants have joined through separate online platform. So queries would be taken by the end of this session. CA Pushkar Kundraji.
Yeah. Thank you so much, Mr. C.A. Dilbag, for the introduction. And I'll just share my screen so that just confirm if you can see it once. Yeah, I hope you can see my screen.
Yes. Please go ahead. It is visible.
Perfect. So welcome all of you. Thank you so much for joining today. And yes, I feel delighted, and it's an absolute pleasure to be a part of such initiatives taken by CPE. Sharing the knowledge or sharing the the taxation structure in UAE. So the Indian CAs can get a glimpse of what humongous tasks that they have been doing in India, and what is it there to experience the same in some other country who plan to move out or set up a second practice or a branch or of chartered accountants. Because this first thing I can tell you, Indian CAs are valued all across the world, all across the globe, and especially in UAE. There is a huge value for Indian CAs here. It's as good as an accepted degree as if it is done by UAE government itself. So more than the ACCA, sometimes we feel that Indian CAs, they have that aura to them when they speak or when they meet with people. They have that knowledge with them. They can truly add value to a lot of businesses in UAE as well. Now, my topic today is, professional opportunities for CAs in UAE taxation. I'll just, before going to the overview of taxes, what are the taxes here, I just want to give a small, I want to quickly touch upon the geography of UAE and the dynamics of UAE. Just if I hope my screen would be visible. You can move my face, otherwise, Yeah. So UAE, or United Arab Emirates, is a country which is located in Gulf Peninsula, and because it's so centrally located in the world, you can see, the map which I've just presented. It's so centrally located that it has become a hub for international transportation of passengers and aircraft and goods. It's become a shipping hub all across the world. And in fact, just to tell you a quick story. So when I was, I qualified for my CA, I belong to Amritsar, Punjab in India. And because of the opportunities, I moved to New Delhi. I was working with one of the big fours that time, doing GST implementation, impact assessments, and everything there. And the commute from Delhi to Amritsar used to be with using a train, Shatabdi or Rajdhani, which takes 6 to 7 hours or an overnight journey. So my father said, any which ways we see you on on holidays, or we see you only during some long weekends or so. Why don't you move to Dubai? It's 3 hours flight from India. So just how close it is from India, and it is in fact a direct flight. So I moved here in Dubai, and in fact I feel at home because around 50% or more than 50% of the people living in UAE are in fact from India. And we mostly even the local Emiratis, the local people here, they speak Hindi sometimes to shock us all. So it is a part of, it feels like home only, and it is actually a 3 hours drive. So before COVID, I remember in 2019 I had around 10 visits to my hometown just for extended weekend like that. Yeah. Yeah, and just to introduce now within UAE how it is structured, this will be relevant for some later part of the presentation as well. Like how India we have states, in UAE there are 7 emirates. One is Abu Dhabi, which is the biggest in terms of land area in UAE, which is also the capital of UAE. The second is Dubai, where I'm situated, and I don't think so I need to introduce Dubai to everyone because people don't know UAE or United Arab Emirates, but they know Dubai. They've heard of other countries, but everyone knows Dubai. I believe they're the house to Burj Khalifa, and one of many holding many world records, and also currently where Expo 2020 is happening. So I would definitely recommend that to everyone. Then there are, apart from this Dubai and Abu Dhabi, there are some smaller Emirates: Ajman, Sharjah, Al Quwain, Fujairah, and Ras Al Khaimah. So these Emirates, they operate here as they have a local government. So Abu Dhabi, they have their own emirate government. Dubai, they have their own government. So Dubai government, Ajman government, Sharjah government, and at the central level there is a federal government or federal authorities, which is taking care of the entire all the other policies, implementation of policies, and making all the policies. Next, and very importantly, I would like to just introduce everyone to the concept of free zones in UAE. This will be important for all taxes, in UAE. Whenever we talk about, because it's not like a full country wherein there are some zones, but it's like within UAE there are around 40 free zones. Now, what are free zones? Basically, these are certain designated areas, fenced or unfenced, where people can operate freely without the laws of the UAE. Now, they have their own laws. So there is the biggest one. I mean, around this 40, the biggest one is Jebel Ali Free Zone, which is in Dubai. Then there is Dubai Airport Free Zone, again in Dubai. Then Hamria Free Zone in Sharjah, Sharjah Airport Free Zone, again in Sharjah. And these are all fenced free zones. So when I say fenced free zones, basically an area where I cannot just walk in, buy products and come out. I need a pass or an approval to go in and go out. I cannot just take out goods or freely from there. They are all very, very restricted certain areas. The benefit was earlier that if you want to operate in UAE, if you want to do business in UAE, a non-resident, expat would need and on paper give 51% holding to a local Emirati when you are setting up a company here, and that's how mostly all the MNCs have been set up. On paper, 51% holding used to be with a local Emirati. Even though there were some agreements they used to enter into, side agreements, and of course the MNCs held the majority share, 99% or 100%, the companies used to compensate the locals with giving money. But on paper, the locals were 51%. Then the UAE government realized, because of the law, they realized this potential of so many companies, because it's such a hub, centrally located, shipping companies will open offices here and everywhere. They wanted certain zones where people from outside can come and do business and own 100% shares. So for that reason, they opened up first, I think, Jebel Ali Free Zone was opened up, and then so on. Now we have 40 free zones in UAE. So these areas, if they are fenced, you can compare it like SEZs in India. They have certain exceptions. From customs, they have exemptions. From corporate tax, they have exemptions. From VAT, they have certain relaxations, and so on. So that is why these areas are very, very important. We'll get into that for each tax, but I just want to introduce them right now. And then there are certain unfenced free zones, which is the only benefit of opening an office there or opening a company there, which is Dubai Internet City, Dubai Media City Free Zone. These all free zones. The only benefit is that this 100% ownership you can still retain. You don't need a local Emirati partner. However, very recently, last year onwards, the restriction from the mainland of having a 100% partner has also been relaxed. Subject to certain conditions, Indian companies can open up their offices or their businesses in UAE. So if this would be relevant for your clients as well, who want a place holding in UAE mainland and they don't want to share with profits, of course, subject to certain conditions, they can set up in UAE wherever they want. Either it is in the mainland or it is in the free zone. And mainland is just the area which is not the free zone. So UAE, which we call the UAE city, where I live and we work all together, where the consumption happens. Now, coming to the tax overview of taxes. I'll just move my screen once. Yeah, my camera. Yeah. So, first and foremost, this presentation could not have been had at a better time. So, because recently, only last week, the UAE government just announced corporate taxes in UAE. You would have heard the news, you would have seen, read some on news or heard the news that UAE, the tax-free land, or, the tax heaven, which people used to call it, opened up companies here, so many things. Now, with because of the OECD pressure and all the there are a lot of reasons which I'll not come to right now, but the UAE did announce last week that they will be implementing corporate tax. It is already official. It's on the website of the tax authorities, the FAQs, and what and when and how it will be implemented. I'll come to it in a bit, but before this, in UAE there weren't there was not any direct tax, or still now there is no personal tax. So what we had was indirect tax. What I, as a consumer or living person living and using, buying goods and services here, I'm paying to the government is only indirect taxes. So which is custom duty, which is from 1980s, long back they've been implemented, and then excise duties, which is like of a sin tax, and VAT, value added tax, which is the most crucial and the tax which has impacted everyone here. I'll come to details of these, but these were the only existing taxes. Apart from that, because this would be relevant for people practicing international tax here in UAE in the past couple of years, due to the OECD BEPS initiatives, the UAE needs to comply with those, and there were economic substance regulations where all the companies, they need to, if they're doing some relevant activities, they need to file any ESR notification and returns. There is ultimate beneficial owner UBO filing. So it's a one-time filing. Every time your owners are changing, you're required to do this, but you need to tell who are the actual owners of the company, not the Cayman company or the dummy companies. Or you need to identify the natural person and declare to the government. And then there is CBCR reporting, country by country reporting, again owing to the BEPS initiative and OECD. It's just a reporting requirement, but this is not like a tax on anyone. But still, this is where we assist our clients in doing. We do all this support because this will require some technical expertise. So this is one work area which we do. Then local levies are there. So for insurance companies, there is an IA levy which is on the premiums that they underwrite in UAE. There's a 0.25% IA levy. For the courier companies, there's an impost levy which is a Dubai courier company. This take a percentage of your revenue depending on the revenue. Municipality, for hotels operating in tourism sector, they have a tax. It's a levy. I will not call it the tax. Here there aren't many compliances. The government, they just see every quarter or every month, depending, these companies, they need to report to these authorities and pay the taxes or the levies applicable. So not much scope for professionals here in this local levy thing. And already existingly, even though we said the corporate tax is upcoming now, at an emirate level, like from Dubai government, or for a Sharjah government, companies who are operating in, if they are a branch of foreign bank, or if they are in certain oil and gas sector, upstream sector or extraction sector, they are already subject to a corporate tax, which is already in place and they've already been paying. The only thing is there are very few companies which are in this segment. So from a professional opportunity point of view, here also it's mostly saturated and it's a very straightforward forward process. However, the most and deeply wide impacting taxes which we all are working for, or we are all professionally engaged in, is the indirect taxes, custom duties, excise and VAT, and now which we will keep, the things which will keep us busy. In fact, this corporate tax in UAE, there are only 2 pages or 3 pages of worth of information on this, but from that we have already collated 50 pages of material, because that's something that our profession will require and we'll have to equip ourselves with. Moving on now, I'll give a summary of, an overview of what this corporate tax is. Because this is such a big announcement and it will have an impact. This will be applicable for all the companies working here in UAE. I'll just give a brief overview of how it is. So what they've announced first is the effective date. The corporate tax regime will be applicable for companies whose financial years are starting after June 2023. So from next or mid next year, if your financial year is starting from anywhere after August 23 or so on, there are some schools or financial year starts from September to August. For them, corporate tax will be applicable. So for example, if there's a company which is 80 or to 90% of our companies, they have here in UAE, unlike India, we have a Jan to December year filing. I think 90% would be the case, if I'm not wrong. So January to December 2023 year company, they will not be subject to tax for the profit that they make in 23. For them, whatever the financial year starts from 1st January 2024 onwards, the profits will be subject to tax for them. Again, from applicability, this will be applicable for all Emirates. This is not like a local Emirates tax. This is a federal tax. The Federal Tax Authority, which is involved, they will be doing the compliances for this, and they will be just 1 minute. Yeah, they will be involved in taking care of this VAT. And the companies which are already subject to this tax at, this oil and gas extraction companies which we spoke about, which is already being taxed by Abu Dhabi government for the Abu Dhabi companies, for Dubai government for the Dubai companies, these companies will not be subject to this tax. They are specifically exempted. Individuals which are carrying some, doing some activities on a personal account, let's say I am just bought a car, or if I'm selling the car, I make capital gains, that all will not be taxable. But if I'm doing this as a business, then it will be taxable for me. Now, for rates, this is again very minimal rates what they've announced to facilitate the business. So they've given a slab rate. For net profits or taxable income, if it is up to 375,000 AED, or in dollar terms $100,000, then it will be 0% tax. After that, any income above this would be taxed at 9%. This 9% is sort of a very unique rate, not even 10 below, above 5%, in line with other taxes. But that's what it is. So they've kept the rate at 9%. There will be, however, a separate rate for large multinationals. So the turnover of the group of that MNC, if it is more than 3.15 billion dirhams, then they might be having a separate rate. This rate is expected to be 15%, even though they've not clarified it. But due to our experience and UAE signing the Global Minimum Tax Treaty, it will be expected to be 15%. And as an example, so if a company's net profit or taxable income is 400,000, the company, the 375 will be taxed at 0, and the balance will be taxed at 9%. So they'll be paying a tax of 82,250 in that year. So yes, again, minimal tax rate, but one thing which I can tell you from my experience, my limited experience in UAE, I've been here for 6 years now, is that it is just the beginning. there will be, we might see increase in rates. There will be so many other compliances that we will get to see here. But yes, for now it is minimal to support the businesses. And now coming to taxable income, they've said that it will be, again, it's taxable income means net profit using IFRS or any other accepted accounting standards. Most likely here IFRS is prevalent, but we are yet to see that in the corporate tax law what they say. And then there will be certain deductions as specified in the corporate tax law. We're expecting they'll come up with their own rules of depreciation. They will come up with their salary disallowances and whatnot, because here the things are done a little differently when you see the accounting side of it. Then they've said that, okay, again they've clarified it that it is not a personal tax, like how Indian income tax, we have PGBP, we have salary and different taxes within the same law, same act. This is just a corporate tax. There will not be any tax from income from employment, income from capital gains, buying and dealing with real estate, income from dividends and interest on shares or debentures. There will not be any income for which is any income that a person is earning which is not related to the business, that will not be subject to tax. It's only the corporate which will be taxed. But yes, if that individual is buying and selling so many properties that it's his business to do so, and he's doing it in his individual capacity, the reasons permit him to take a trade license, that is basically to register his activities, then that person will be taxable. Other than that, no. Then there will be certain incomes within the corporate which will be exempt from the corporate tax, which is dividend and capital gains earned by UAE businesses from the qualifying shares. Of course, more details will come into this. And then very importantly, free zones. So free zones which we discussed right now, as I was saying, most of these free zones, when these companies opened up, they were given a certain umbrella period, or so you can say a certain tax exemptions when they opened up. So some of them was 50 years, some of them were 30 years. Now, what they're saying is, if there's a company in free zone and they are meeting the conditions, whatever they had to agree, and they're not doing business in the mainland, they're only restricted to the free zones or import and export mostly, then they will not be subject to corporate tax. They will honor their commitment. However, of course, this is a matter of gray area which a lot of us are debating and contemplating what will be the actual rules on this and how will they implement this. So we have to wait. But as of now, they have said that if the conditions are met, they will not be taxing the free zones. Now, a very interesting thing here is also tax groups. There are two or more companies and they meet some certain conditions. Let's say have a common control. If I have 4 companies with me, I can register them as a tax group. They've called it fiscal unity for tax purpose. They show this fiscal unity. For the government, they will be treated as one person, single person. Then the government will, the FTA, the tax authority will not go into how much each company made. As a group, they will see that this is one taxable person. So if one company has a loss and the other has some profits, and they register as tax group, only one common return will be required to be filed, and they will be able to fare away with that. Very importantly, next point is transfer pricing. So this is also one of the messages that was there in the FAQs, that the government has said that yes, corporate tax is there. However, for transfer pricing, all the companies operating in UAE must comply with the transfer pricing requirements mentioned in the OECD transfer pricing guidelines. OECD has its guidelines, and all the companies would be required to abide by those when you talk about claiming deductions and so on. And then they've said that there will not be any withholding tax, and so no TDS or nothing for when it comes to paying out for royalty, interest, dividends, and so on. However, we'll see. This is at this point of time. There's nothing right now, but as I'm saying that as we were internally also discussing, that there will be additions to it as we go. It is just the beginning of corporate tax. It's you can say a new era in this region. And yes, they've given generous transfer of tax losses. So tax losses not prior to this year, but any losses after 2024. For in that example, if there are company, they will be available for set-offs. And yeah, that is it from the corporate tax side. And again, my note on here is, yes, there's a huge opportunities right now. If you go to any small shop or any bigger restaurants or any people who are easily earning profits of more than 374, for them, even they might not get audited. Their books are not being audited as well. They might not even maintain proper books of accounts. So from a setup point of view, that okay, now you have to set up, now you have to make books, now you have to get audited, now you have to pay this much tax, that itself is a huge opportunity for everyone. And this is help shape up the UAE as well. Next, we'll move to UAE custom. Now we move to indirect taxes. So UAE customs is a age-old tax. I mean, it's custom duty. When I'm putting it into a bucket of tax, but it's basically the word customs itself is derived from the customs. It is tradition, part of tradition to bring goods. To pay some duty, right? So the way I learned it is, so when in the kingdoms, when the traders, they used to come to a kingdom to sell their products. Part of that 20%, 10% you have to, or they used to give as to the king as customs or as tradition. So that is why this custom duties emerged, and of course they have more than this genesis to it. But yes, it is a charge on goods which are imported in UAE. So mostly it is either ad value percentage of CIF, or some cases it's on the number of quantity of goods. So there are two major rates of custom duties, 5% and 0%. Most widespread products that we see, this coffee, this water bottle in front of me, this perfume, everything is subject to 5% VAT. So 5% customs, and the other rate is 0% for some electronics and some products which are custom duty is 0%. And for two exceptions, which is tobacco products, cigarettes, the custom duty is 100%, and for alcohol products it is 50% custom duty. And when we import it. Apart from this, there are certain items which are specifically prohibited. Let's say betel leaves or poppy seeds, etc. So betel leaves are, basically I personally love eating pan when I'm in India, because we don't get it here in UAE. So whenever I come to India, I love eating pan there, because it's prohibited here, and those you cannot even import these products. Now coming to again free zones, which play importance here. So whenever the goods are imported in the free zone, or they're transferred within the free zones, or they're kept within that free zones, when I'm talking about this, it's mostly fence free zones, there is no duty. The only duty comes when from the free zone goods are imported into the mainland. At that point of time, they charge at that point of time there is this import duty. So within the free zones, and import, if you're just importing goods in free zone and then exporting it outside from UAE, there is no custom duties at all. And this is the reason why also a lot of African countries are served from here. So the hub is has been formed here. All the imports from China, India, Pakistan are docked here, shipped here in Jebel Ali Free Zone, and then the entire Africa and this region to the south of the Gulf Peninsula is served from here. And when I speak of, and of course from South Africa there onward. So this UAE has become a hub for shipping as well because of this, and that is the predominant benefit or advantage of having a company in free zones. However, free zones, because there is no duty, they have certain extra restrictions. They are required to maintain the stock, and the custom authorities have started auditing them as well, since beginning, but now they've just increased the audit recently. They have to produce all the products, they have to be labeled and mapped to the bill of entry declarations that they filed. In UAE, the authority is there's a federal authority which devises all the custom policies and procedures, And then there are local customs department who do the execution work. So there are in UAE there is Abu Dhabi customs, Dubai customs, Sharjah customs, Ajman customs, Ras Al Khaimah customs, Fujairah customs. So 7 Emirates for you can say 7 local Emirates authorities, and they follow each and every one. We follow, for example, Dubai. We follow Dubai custom rules, whatever the products are and rules are. As a very very recent update, in customs, recently the UAE customs, they've adopted the WCO HSN nomenclature, which earlier was they were following a GCC nomenclature earlier, but now they've just followed the WCO nomenclature to standardize things. Now it's in line with all the GCC and in fact a lot of countries, around 190 200 plus countries. Now it is becoming, it will be I would say it's a good step, and it makes our lives as chartered accountants easier to classify the goods. And because we've all worked on for different countries, we have a WCO standard HSN which we can use. Yeah, moving on to excise. Moving on to excise. Now, excise is typically levied here on goods which are considered harmful for the health of people. So the idea is to charge and make those products heavy or expensive so that people don't consume those goods. Now, if you see, this is not the excise that we have in India in production of everything that we used to have. This is basically, also we call it a sin tax, sin. So to consume these goods is a sin and a luxury product, and people should not be consuming it. So if you see the products which are there, very very limited category. So they have tobacco and tobacco products, including this electronic smoking, the vapes and the shisha and all these liquids along with that. That is tax. That is the excise rate is 100% for them. Then they have carbonated drinks, CSD, carbonated sweetened drinks, which is Coke, Pepsi, Cola, all these fizzy drinks, that they are taxed at 50%. Then there is energy drinks, so Red Bull, Monster, and so on. So many energy drinks which which were there. So those are all the caffeinated beverages. They're all taxed at 100% excise. And then recently, from December 1st December 2019, all the sweetened drinks. When I say all, I mean every sort of fruit juice or any sort of juices which has added sugar in it. Everything came into the bucket of excise at 50%. So that covers a lot of market. When we go to a grocery store, there is an entire section of excisable products, which now of course it doubled in price when we look into that. And the excise was implemented in 2017 for all the other things apart from sweetened drinks, but now it is such widespread that a lot of companies are impacted by excise. So just to understand who and when pays for the excise, so any person who is importing these products, they are required to register these products with the FTA, and they have to pay the excise duty at the time of import. So how it works is, whenever I'm importing some excisable products, right, before that I have to register those products with the authority, tell them that how much will be the MRP or RSP, we call it. Like to explain you better, I'm saying MRP, it's RSP, a retail selling price. How much will this product be sold? And I pay excise duty on this percentages on the RSP of the product. And at the time of import, before the custom declaration, I go to the online form, I file a declaration that I am importing these excisable products, and I pay for excise duty. So importer pays at the time of importing of these goods. Then producers, the manufacturer of these, when someone is producer or manufacturer of these products, which they are doing it in mainland or without a designated zone, they pay this excise duty at the time of production when these goods are produced. And they again file a declaration with what they are producing and what quantity, and they pay for this excise. Then for stockpiler, now this is a concept where, for example, I'm a seller. I sell 20, you can say, cans of beverages in a month. Now from tomorrow, I know this 50% rate is going to become 100%. So what I'll do is I will stock 200 units with me, because I'll sell at a higher price because the RSP will change, but I will buy it at a cheaper price because the rate is going to change. Now, as on this date, if a person has more than 2 months average of stock, of the date of the change. In that case, the excess stock, so in my example, 40 is okay, anything above 40. So the balance, if I've stocked 200 units, the balance 160, I have to pay excise from those from my own pocket. So I will become a stockpiler. So any rate change, any new things bought under the umbrella of excise, if I'm stocking as on that date, I have to pay excise on that. And this another one more area where excise the person will pay is a designated zone release. So what is designated zone? So just like free zone fenced area, which I explained, a person who's manufacturing, importing these products, he can register his factory, warehouse, or a premise as a designated zone. What would the benefit of that is? So if they're producing, let's say they produce 10 units today, 20 tomorrow, until and unless it is released in the mainland for consumption, for general public's consumption, he does not need to pay excise duty from his pockets, because otherwise you're just producing and the stock is lying there. You end up paying so much excise and the goods are not even getting consumed, because it is not like VAT. It is a first single point of tax, first point taxation, and it is not till the time actually it is consumed you will be getting this benefit. So that is why a lot of people, they register their factories or premises as designated zones. For that, they appoint a warehouse keeper, which is basically the company, which is, they call themselves a warehouse keeper, the person in charge. And so that's why the law is drafted that the warehouse keeper has to pay on release of goods from the DZ. So any production that you're doing within the DZ, you don't need to pay excise. The moment you release from the DZ for outside, for UAE consumption, you are required to pay the excise on that. So this is the who and when excise is paid. Just a couple of compliance related things. So there's no registration threshold for excise. Even if one person is just wants to be engaged in conducting any of these, importing excisable products, manufacturing them or selling them, he must register with the authorities, with the FTA, within 30 days from the end of the month in which he's already gotten engaged or he intends to be involved in that period. So they've given a 30-day timeline. By default, for excise, everyone has a monthly tax return. Monthly excise return needs to be filed, and within 15 days from the end of month. So for every 15th, for whatever excise clients we have, every 15th, 10, you can say from 5 to 10 or 10 till 14th, we're all busy with the excise filings, which we are doing for our clients, because a lot of reconciliations are required, a lot of declarations are required, and so on. So that is something that keeps us busy till the first half of the month. Then one important point is that all these products have to be registered with the authorities in advance. So I'll just tell you what happened recently. So Expo 2020, and one of the countries, they wanted to import one tobacco. That country, they were very proud of that particular tobacco product, and they wanted to bring it to showcase it, only for showcasing that's a homemade sort of a product indigenous to their country, and they did not register it. They did not have an RSP to that product, and because the product was not registered, the custom authorities and the excise or the tax authority, they did not allow for that product to enter. So within the matter of 2 days or 3 days, they were required to prepare a lot of documentation, the ESMA certification, the FSI clearance, everything, that these goods are fit for consumption or no, and what are the degree of post everything, the stickers on the marketing and the branding of these products. And then they were within 2 days they had to do all this to register that product. Even for that one single product, which was tobacco product and hence excisable, they had to do that all the compliances. So this product registration itself is a huge compliance which we do. A lot of people still, they are sometimes might be selling a lot of products which has added sugar in it, but they're not registered it. So when the authorities catch them, of course there is so many fines and penalties on this. And just one more point on excise is it's all a declaration based system. So at each point, at a producer or as an importer, you are filing a declaration with the authorities that today I've produced this much, or today I've released this much from the free zone, or today I've imported this much. So at every day, probably one or two, you're filing a declaration with the authorities. And when you're coming to the return in 15th, then the return is mostly pre-populated. Of course, there are some adjustments that you might need to do, but the returns are almost always pre-populated for companies having BZ or importers, and that much excise liability is also computed. And by 15th, we are required to pay this excise. So any change in the return and all, we are also required to update the declarations for that, because the excise, these declarations are also statutory documents. It's all electronic, it's all on the website. We go to the authorities website, we file a declaration, we select the product which is already registered, we just enter the quantity and so on, it flows. So that is for the excise. Now coming to value added tax. This is the most widespread, tax which has impacted everyone in UAE. This is, it's first and foremost, just to clarify, this is not the VAT or the value added tax that we used to have in India, which I remember, which I was working on. Each state there had their own value added tax on goods. This is, the name is VAT because it's borrowed from the UK and the European Union. It's borrowed, the terminology is borrowed from there. However, it is just similar to a goods and services tax, GST, which we have in India. It is applied on goods and services both. It was implemented in January 2018. And again, this is not a cost to any business. However, it is a cost to consumer, like we people who are living here. If I am buying, there are, just Vishal Mega Mart, for example, if I am buying 3 water bottles on, I'll be paying the extra 5% VAT to the retailer, and so on it flows. Similar to GST, which is there in India. So some key features here, it is on goods and services both, and also on import of goods and services in UAE. It will be throughout the supply chain. There's no exception within the supply chain. Like excise, the first point producer, he pays and that's it. However, VAT is a manufacturer or will charge to the distributor will charge to the retailer will charge to consumers. And of course, there is a input tax credit mechanism, the GST credit like we have, and the only net payment needs to be done. Also, it is there on deemed supply, similar to GST in India as well. Whenever they are giving, anyone is giving goods for free, there is also, you need to check for deemed supply. There is some certain supplies are already deemed that this is a supply, and on that VAT will be imposed. Now, there are some exclusions, that again, like in UAE, in VAT also, there is a concept of tax group. 2 and more companies, if they have a common ownership, they can form a tax group, and those 2 or 3 LLCs or limited liability companies, that's how the companies are, they form and they file only one VAT return. Any intergroup transactions that they do, it's no VAT is applicable. It's not regarded as a supply. Some transactions, let's say, which are compensatory in nature, for example, an insurance claim which I got, or let's say damage claim which I'm getting, that is also not subject to VAT because it's not a supply of goods and services. And then if I'm transferring my business as a going concern, that is also an exclusion. That's also out of scope from VAT. That's also not a supply. Other than that, I mean, supplies which are made in UAE, of course, we'll come to the rates, that is subject to VAT. Now, when I say supply made, is supply is defined as sale of goods or services, or giving goods or services for a consideration, like when I'm getting something in return. So if I'm for goods, this just clarified that if I'm transferring the right of ownership, disposal of if I'm disposing the right of ownership at a future date, or if I'm even I have to make a compulsory transfer, these are all supply of goods. Here also, tenancy contract, which is like my house, let's say I'm living in a rented apartment, that supply is a supply of goods, not a service. They've specifically clarified. And this I remember in India, VAT and service tax, there were case laws when I was there. Is renting a transfer of right or a transfer of right of ownership? Those sort of case law. There's a judgment of Volkswagen back in the days. So any which ways, here they've kept it simple, then very they've clarified it, what is goods and what is services. And the best part is there's no bifurcation in the rate. So goods is also subject to tax at the same rate, or 5, and services also 5%. So there's no confusion, and it's only one authority. Unlike in India, there was center and state. Here, there's no confusion. Now, services are defined as anything that you are selling apart from goods is services. So, goods are anything that you can touch, feel, and see. Services are anything that else you are selling is a service. So, even waiving of any rights as activity of not doing anything, just like the Indian Service Tax or Indian GST, not doing anything is also a service. That I will not open a shop here if you pay me 100,000. That's also a service. So, those kind of things are also defined as a service. Just one example of how VAT works. I want to just take quickly that how VAT works in a supply chain or for a company in UAE. So I'll just take one transaction at a time. So let's say there's a supplier in India who is exporting goods to ABC, this company in UAE. The first transaction is import of goods, right? So there is a custom duties which is there on import of goods in the UAE mainland. Then this person is buying goods from a local supplier and he's buying some services from a local, he's procuring some services locally and he's selling it to a UAE customer. Typical business model having three transaction on purchase side and one on sales. So VAT is there on each leg. So when he's buying importing, there is an import VAT which is over and above the VAT. It's over and above the custom duty. And when he's buying services when he's buying goods locally, he's paying the VAT to the supplier. And when service provider is giving him services, let's say my services or rental, whatever he's taking he's taking, that is also subject to VAT. And when he's selling the goods, he also needs to charge VAT. So the VAT rate, most common VAT rate is 5% on all goods and services. So in this example, what I've done, just to show you, let's say the value of good that he was importing was 1,000. He was being charged a 5% duty, custom duty on that 1,000, which is a CIF value of 50. And there was an import VAT of 5% that will be on top of the CIA value plus custom duties, so 52.5 dirham. So total the cost is still 1050, but he'll pay out 1102.5. Then when he's importing goods locally, he will pay, so on the product cost is at 500, but he'll pay a 5% VAT on that in this transaction too. So 25 he'll pay 525. When he's importing a service, let's say valued at 100, he will charge a 5% VAT. The service provider is required to charge him the VAT, so he'll pay a 5 extra as VAT. And when ABC is selling to the customer, let's say earlier the sales value was 2,000. Now he has to charge a VAT of 5%, 100 VAT he'll charge, and 2,100 total he will collect. Now when he's to every quarterly or monthly, whenever this tax period is, in this example it's quarterly, when he's when he's doing his return filing, he will say how much VAT he has collected, which is 100. So he has collected this 100 extra in cash from customers. My bad. Yeah, and he's already paid 52.5 import VAT at the port. The VAT he's paid, service provider 5 and the 25 to the supplier. So whatever total VAT he'll collect and take an input tax credit of that, and the net VAT payable will become 17.5. That's how very in very simple words I just explained the VAT to everyone. I'm assuming, GST in India is much more complicated than this, but this is how it is. In fact. Simple when we compare it to the execution of it, because it's only one rate for goods and services. There is no vendor matching concept as of now. We just need a document evidence from the service provider and the supplier and the bill of entry copy that we have paid this VAT, and the invoice should be correct, and we can claim this input tax credit from the government. Now, as I was explaining VAT, so all the rate, they've kept it, the minimal rate, the VAT rate is one of the lowest in the world of 5%. All the goods and services all provided in UAE will be taxed at 5% rate. Now, there is, so unless the supply is exempt or zero rated, or it's not a part of VAT, it's not a scope of VAT. So, So what the key difference is, everything which is 5% vatable or 0% vatable rate, these are all taxable supplies. Anything that is, there is an outflow of 5% or 0%, the input tax is eligible. But if the supply is exempt, specifically if my output is exempt from VAT, then I cannot take the input tax credit off on my purchase. So the deduction what I've paid to my, suppliers and vendors, I'll not be able to take if I'm making an exempt supply. Now, just to give an overview again, what is zero rated and what is exempt and what is out of scope in UAE. So whenever we are exporting goods and services from UAE to outside, it is zero rated. Healthcare services and medicines, that is all zero rated, subject to zero rate. Education services, schools and everything, that's all zero rated. There's no VAT on that. International transportation, so which is, as I was saying, it's mostly, a lot of logistics companies, they import and they sell, or this, they do the transportation from one place to another place. If it is international, like one of the to or from is outside UAE or in UAE, then it is zero rated. Rescue aircrafts, boats, luxury, all these auxiliary ships, crude oil and oil derivatives, national gas, it's all zero rated. And the building, when full building or the residential building, when it's supplied first time, that is also zero rated. That means all these sectors, like say education, healthcare, they're always in a refund position, because they don't charge they charge 0% VAT to their patients or customers or students, but whatever VAT they pay to their vendors, they can take a deduction of this and they're in a refund situation. However, some supplies are exempt. So bank interest, for example, banks, when they are charging interest to people, that is exempt. If someone is selling bare land, only a piece of land, that is exempt. If a company is selling real estate from, a residential one, that is exempt. Or renting of residential real estate is also exempt. Local passenger transport, these cab companies and all, these are all exempt list. Now, the difference is, all these companies, let's say this local passenger, a cab company, the Uber, for example, here, which we have. So Uber, whenever they buy a car, they have to pay the VAT. Uber, they take services from us, for example, they have to pay VAT, but they cannot take a credit of that. It's a cost for them. And that is, the difference between zero rated and exempt supplies in UAE, which is very, very crucial to note. And some supplies are out of scope, which is basically if a person is not taxable, salaries, for example, if someone is just buying and selling, one car, for example, I sold my car, that's not a business that I'm doing. So those kind of supplies are out of scope and there's no VAT on that any which ways. So it's only mostly for businesses. Again, so now registration threshold for VAT is 375,000. This is the turnover limit, this is the sale limit, plus including the import of goods and import of services. And this, from my experience, just to let you know, this, even a small salon shop for haircut, that will also, someone will make this much in a year if they're operating in UAE. So most companies which are in B2C space, or they are into making supplies in the this to consumers, they ideally would have or should have crossed this threshold, because in 1 year 375 sale number, it's very easy to do. So once you cross this threshold, within 30 business days, we are required to register with the authorities. Now FTA, which is the authority, will allot either a quarterly or a monthly tax period, depending on the volume. Most likely now, whoever is applying for last 2-3 years, they've gotten only a month quarterly tax periods. And the return needs to be submitted. So if it's monthly or if it's quarterly, depending on the tax period, 28 days from the end of that tax period, we are required to file the VAT return. So VAT return again is the e-form. You need to, you're required to file VAT, you go upload. There's nothing automatic. You have to fill in, you have to pick out data from, your system, see how much of this, the calculation which I just showed you, 2,100, how much sales you made, how much purchase you have, what are the documents available, and you submit. It's a self attested return. And of course, we as consultants, we help companies in filing these returns. We review their data before, correcting the returns, because one thing is there, which I would like to tell you everyone, is this VAT here is still very, very new compared to what is there in UK, what is there in other countries compared to India, which has a so many history of so many case laws, so many things. Even in UK, I think after 20 years or 18 years, I think it got decided that this Pringles, which we eat, is it a wafer or is it potato chips? That was a confusion. So I think the case law was that it does not contain enough potato to be called as potato chips, and that got so many years to resolve. There's another one, wafer. I think is it a cake or a wafer? What is that? So because the rates were different. So this here, I mean, because of so many years of litigation and the tax law evolves, here it has been only since 2018, and it's the fifth year which we are going on in VAT. There is a lot to which will change, which will come. Already there have been 2-3 amendments in the VAT law, which are very, very crucial. Very, very important conditions are there in those amendments which people need to take care. So this is UAE VAT law is constantly evolving, and it will keep on evolving until I think years to come. And moving on the supplies, I mean, when we are filing the returns, we are based on our location or based on the rules, we have to report supplies emirate wise, because VAT, as I said, is such a widespread thing. Each and every emirate, they get revenue from. How do they determine how much revenue they'll get from VAT is based on the people's return which they file. So based on if I am operating out of Sharjah, I will report all my sales are in Sharjah, even though the net payable there's a system how the government allocates the money, but as a taxpayer we are required to report emirates wise this reporting. Then again, free zone. So basically, as I was telling, again, free zone, they will have some special status here as well. So out of the 40 free zones, whichever are the fenced free zones, they're called designated zones for VAT, which are complying with the conditions. So I think there are 25 of them in UAE wide, there's a list of designated zones, which is basically the free zones. They have special provisions for VAT as well. For services, there's nothing special. It's you charge as good as you're operating in a mainland. But when it comes to goods, since it's a custom bonded as well, when you're importing goods into the DZ from outside, let's say from India to DZ, there's no VAT. In that example, we saw 52.5. There's no VAT. If it is we are giving from DZ to someone else for DZ for trading, not for personal consumption, then again there's no VAT. When it is given for consumption, then yes, we have to charge VAT, because it's as good as me buying in the mainland. I could have bought from a mall. Why am I going to the warehouse and buying it? So again, to keep it parallel, we have to charge VAT. If I'm sending goods from DZ to outside, let's say from Jebel Ali to Africa, there's no VAT. But when I'm importing goods from DZ, in this DZ to mainland, that is the time when it is considered as an import. So custom duties and VAT both will come into picture together when we are importing goods from free zone to the mainland. And also one more exception to this, it's similar to what we have in SEZ in India. I think most of the principles would be same. But when I am supplying from mainland, UAE mainland, to a designated zone, I have to charge VAT. I will not say that this is an export, so me as a supplier. So that is one exception. Apart from that, they have given a lot of relaxation from other when you come to DZ. However, recently the law was also amended, and now there are additional declarations that are required to be kept for to not charge VAT. Yeah, moving on, just want to quickly cover the penalties under the UAE VAT law. So for with regards to penalties, so first thing I'd just like to tell you, even though the VAT rate was 5%, one of the lowest in the world, historically, the penalties in the UAE VAT law were the highest in the world. So earlier, let's say, when I'm talking about earlier, I'm saying up till June last year, if I made an error in my return, and let's say the VAT amount I forgot to pay to the authorities, 100,000 dirhams of VAT to the authorities. In that case, I had to pay 100,000 as VAT from my own pocket, because I would not have maybe collected. Second, I would have to pay 300,000 as penalty. So the penalties used to be 300%, even though I am myself revising my return and correcting it and sharing it with the government. Now, in June last year, 2021, there was you can say a landmark amendment in the VAT laws, wherein they said that we are reducing the penalties for everything, for every issue, we are reducing the penalty. So I've just kept 7 penalties which are there on the screen, just to, I don't want to delve into much detail, but this is for VAT, excise both. If I don't issue a tax invoice or tax credit note, the penalty for each discovered case is AD 2500, right? So that is around 50,000 per document. So that is a big number, of course. As per UE standard, also it's a big, big amount to pay for a taxpayer. 50,000 INR he has to pay for, not issuing a document correctly is a big amount. And but this is a reduced one. Earlier this used to be 5,000, double. So 1 lakh, for example, he had to pay. Then, if someone is late in registering or deregistering, the penalties are up to 10,000. For registration, if you're late in registration, the standard penalty is 10,000. So 2 lakh rupees basically is paying, just company is paying just because he was late in registration. So if you filed an incorrect tax return, so only one point is, if not, if the return is incorrect, as in because there's no VAT payable, but just a formality. So the penalty is 1,000 to 2,000. First time they make it 1,000, but after that it's 2,000 always. Then late payment of taxes. Now this was the big penalty, which was up to 300%. So now they've reduced it. So they're saying it's only if you're you don't pay this 100,000, we'll charge you 2% for the penalty, 2%, and then 4% per month of the tax amount. So now if I, for example, I pay 3 months late my tax liability, instead of paying 300,000, I will pay 12% basically of the tax. So 100,000 of VAT and 12,000 as penalty. Then filing voluntary disclosures before tax audit. Now this is very crucial. So if I am myself correcting my return, which I see I've observed some errors in, the penalties are from 5% to 40%, depending on which year. So if the error is 3 years old, then I'll pay 20%. If it is 4 years old, I'll pay 30%. If it is just recent error, I'll pay only 5% of the tax amount, the penalty. Earlier, this also used to be 300%. So that was a dreadful one, but now they've substantially reduced. However, when an audit happens, an FTA, the tax authority, they find an error for us. We have not self-disclosed this. The form is still called voluntary disclosures, but that's an audit basically which happens. In that case, the penalty is 50% starting, and then 4% from the date of the error. 4% is, let's say if they see an error in January 18, then I'll end up paying again 300%. This is again up to 300%. So again, I end up paying 350% of penalties in this. So the only message with the authorities have given is, please correct your errors yourself as soon as you can, and don't wait for an audit to start. So a lot of our time, we'll cover audit also next, but a lot of our time, we've seen, we assist clients in audits and how they're going in, what FTA is requesting and whatnot, and they do identify these errors, and they've penalized it from beginning. And there are cases where the demands have been raised from 2018, which is huge numbers, like in millions. Some of the companies have so much demand that they said that it's better we just stop doing business. We are not able to pay the VAT also from pockets in millions. Then how will we pay this 300% fines? So yeah, there is an amnesty also going on for old penalties. If they are still unpaid, FTA has announced an amnesty scheme that the people, they need to pay only 30%. This is for VAT, excise and customs, all three. So only 30% amount they have to pay within this year, and then they'll get a waiver of the 70%. This I'm talking about in the old penalties, when they were in these 300% and which were in millions. So that we can also, just for information, we can see. Now, just recourses available for the taxpayers. Now, just quickly, I want to discuss also, this is also our basically scope items, what we offer clients, or what as a professionals we can add value to the clients. So one is technical clarification. So whenever there's a doubt in how to interpret this excise law, or how to interpret this VAT law, is it 5%, is it 0%, or what will be the treatment of this There, like how we have advanced rulings, here we have technical clarifications. It's a little mellowed down version of advanced rulings. It's an online form. You have to fill in. You give 2-3 views to two views to the authority, and ask the authority that what is your view, what we should do in advance, or we can also do it for the past or existing transaction. So we do assist clients in that, and this is only to rule where the law you think is grey, or you want to ask authorities what is their view. It does not come with any cost for the taxpayer. They can self also do it. It is just that the authorities take 40 business days to revert to you, or even more, and that's the minimum. And then there is administrative exception. So if your tax invoice is not compliant, or tax credit note is not compliant, or you don't have export of goods, for example, is very, very crucial, because they have like so many documents that they ask for. If you're unable to get certain documents, or if you're there are like 8-9 reasons basically. If any of those 8 reasons of provisions of the law which we cannot follow or abide by, we have to get an administrative exception for that client, for that taxpayer, so our taxpayer can get it themselves. That so that they don't get these hefty penalties of 2,500 per document or so. So this is a second recourse, that a taxpayer, if they cannot, their ERP system is not able to follow the format given by the authorities and the points which are there in the law, then he can file this admin exception. The another is reconsideration, where we ask FT to reconsider their decision, meaning that please change. What you have you have ruled on this way. Please reconsider your decision. This is not correct, and so on. So this can be for anything. And then there is exemption and waiver, which is very, very new, effective from 1st March. There's a new decision now. If you have suffered a penalty for certain reasons, you will be able to ask the authorities that please waive my penalties because of these reasons, and please accept my request. And this is another recourse available to ask for reduction. And we've seen recently a lot of our clients, they have gotten benefit even before this exemption waiver has come out. They've gotten a waiver already from the FTA on the penalties, which are huge. The entire process, the dealing with the authorities here, just to add to these points, is mostly through so far in all the registrations or return filing or all these things, is mostly through e-services. Yes, I mean we here can register as tax agents, like my firm here is registered as tax agents, wherein which we can go to the authorities and we can ask for the details, or we know some people to help us to speed up things. However, as a normal process, everything is online. We don't need to go anywhere, meet anyone, and it's just automatic. We follow up on the system. Everything is very well automated and you can say easy to do for everyone. But of course, taxpayers, we as professionals, it's a benefit for us, and also the taxpayers, they can always see what is going on and themselves also file here. But it is all electronic. That's one thing. And this is before COVID also. It's not because of COVID this has become electronic. Earlier also it was like that. Yeah, so that is just on the overview side. Now I would just, in the interest of time, I'll just quickly in the next 5-7 minutes, I would just like to tell on how the FTA audit process is. Now, up till all this process which we were talking about, it was all electronic and mostly, there's no interaction required also with the authorities. FTA being the Federal Tax Authority here, but for normally when they audit, this is the next process, so which I want to discuss quickly. So basically, in the beginning, in 2019 and 18, and towards the end, when after the law was implemented, FTA started or initiated the tax audits as well. So in 2019, we saw in 2018 and or 2019, our clients were getting, FTA audits notices they started receiving. Earlier, they were focused on very, very big groups, large MNCs. So yes, by virtue of our clients, I was able to see or work on how the FTA audits and get the workings of that. But now what we have seen is last 2 years, they have started targeting, one is SMEs, but also small shops, like they will go to they'll ask for the data from in a proper format from a small shop which is just earning 500,000 or 1 million dirhams in the year. So they've also started auditing the small shop because they don't want anyone to sort of lose out of the bucket that everyone should be compliant. And since it is an automated system, like it's a self attestation which of the VAT return which everyone is doing, it is important to have these checks and balances. So just to tell you how the typical audit process is, they issue a notice. In their notice they give, there's a questionnaire, and they ask for the sample. They can select tax period or returns sample, or they ask for all data. They share over an email mostly. They share a format also, Excel file format, in which format they ask for your data, the entire data, sales, purchase. I'll show you the format also. But then once the notice is received, the most crucial thing is they only give 5 business days to collate all the data that you have in their format and give it to them. So that's what basically we recommend all our clients is to maintain already the return data in that format. However, of course, there are different systems. There's so many systems, SAP or Apple, they cannot produce in that common format. So there will be some adjustments required. So they don't. So the only thing is 5 working days. If you get a notice, that becomes very, very crucial for us to, support that business and get all the data sorted. And before giving to FTA, once checking it and seeing what we can, how to share the data, what we can in the presentable format. Then FTA, they once we see the data, they request for additional records and the supporting documents. Now, in supporting documents, they can select sample invoices. They can ask additional questions. Once we share this information, they also visit our premise also. Sorry. Can I continue? Sorry. Okay. So so they also ask for our they visit our premise, and they interview the tax manager, and they ask questions. What are the tax position adopted? What are the things what you've been doing? How are you charging VAT on what sales you're charging? And during that they try and get more information from us. Now, the most, just to quickly tell you, there is a questionnaire which we have to fill in an audit. There are 30 to 35 questions. Each and every transaction, sales, vendor wise, I sold 2 Pushkar 5 dirhams of bottle. That time sales transaction listing is asked. Each and every category of income, what is the nature they're asking. The tax document, your tax invoice, tax credit note formats to check if it is compliant, or you have an admin exception, refund or something. Trial balance and reconciliation, which is a key. That is something that they ask. And even in this is the FT audit, but even for refund, there is a mini, you can say, verification which they do all these things in. So for refunds also we are supporting our clients. That is one opportunity, but that is also a lot of work. And also when it comes to the audit, there's a bigger chunk, reconciliation, group structure, apportionment, how they're doing, and so on. So this these are the formats. I'm due to some technical glitch, I can't. I don't think so it'll be visible, but I can attach it if someone needs a presentation, I'll put it in. So basically, these are formats wherein each and every sales need to be listed one by one, and to show that what they're asking. So your invoice number, invoice date, customer name, customer registration number, and so on. We need to give line by line. Even for autoscope, something which is not VATable, we have to give a list to match it with the PNL, with our PNL or with our revenue trial balance. For input for box 9, when we are claiming this, in my example, this 5 and 25 which I am claiming, the tax vendor invoice number. What is the date of the tax invoice number? When did I receive that invoice? When will I pay this, or when I have already paid that invoice? All this information is required in this. And then some certain other audit questionnaire, the 30 to 35 questions, they're asking about the ownership details. What are the conditions for fulfilling zero rate? Because for services they made an amendment to the law and made it very, very tight. So zero rating from UAE is becoming, you can say, very challenging. For each and every step there are multiple declarations to say that VAT is zero rated. When we come to export, there are multiple things which we need to look at, a lot of conditions. So they also know, the FT also knows that, and they try to find errors there. These are just sort of to say that yeah, these are certain condition questions which they ask. Bad debts, how you accounted for. Recovery, how you're doing. What are the entertainment related things. Some negative list which we cannot claim. How are you? What is your policy on that, and so on. And yeah, when they meet also physically, they do select 5 high value invoices. How did you tackle the transitional period, motor vehicle and entertainment, personal use? These are specifically disallowed. So how did you claim those insurances, or those expenses or no? Insurance expenses, did you claim or did you not claim? These are just sample questions that they ask. Just certain do's and don'ts. What we say is, the records should be in English and Arabic. It's not mandatory to keep it in Arabic here, but when the authorities want, they can ask you to convert. So it's English, of course, is but a suggestion would be to make it in Arabic as well. We have to respond to the FTA timely. We have to give as detail and not to hide from the authorities. Reconciliation should be prepared now itself, not waiting for the audit. But also the companies, all the staff of the companies should be prepared, and that's where also we come in, where we give a lot of trainings, which who better suited than Indian chartered accountants, where they give trainings on each and every, what is the VAT for their company, how their company staff should be there. Because because one of the don't, which is underprepared staff, we have seen a case, one client, the staff got scared, I believe, or I'm not sure how I should say that, but he gave out so much information that because of that one company, now the entire whole group became under audit because he shared so much extra information also. But yes, that is, from it, the system should be capable. Basically, that is the bigger picture that we see, that system should be capable, and we should all the companies, they should plan and do some mock audits and some sort of and prepare in advance. That's the key takeaway. But yes, these are all for customs, VAT, excise, all the taxation, and this is how we as Indian professional CAs come into picture. With this, I end my presentation. Any questions, anyone, please feel free to ask. That's it from my side.
Thank you, sir. So there are queries. Some of them. The first query to you is, am I audible, sir?
I can hear you, Dilbag.
For an importer of the excisable goods, should he pay the customs duty and also the excise duty? Meaning, are both the duties leviable on excisable goods?
Correct. So Dilbag, thank you. So yes, very valid question. Yes, so when your custom duties is a tax which needs to be paid for, as per the rates agreed. But yes, so if it's an excisable product, both the duties, and I will say 3 duties now, 3 type of taxes: custom duties, excise duty, and VAT. All 3 are leviable. So just to give an example, if it's an alcohol, for example, alcohol is not excisable. So let's say a tobacco product which is imported, 100%. So let's say the value is 100 of CIF. There will be 100% custom duties, 200, then 100 on the RSP, whatever the RSP of, let's say, another 200 on the excise, and then on that value VAT also. So it's a combination of all. So all 3 taxes are levied on this. Yeah, I hope that's clear.
Okay, sir. The second query to you is, for a producer, it is understood that ED on cost of production. However, in India, it is on invoiced price. Please apprise.
Okay. So here, this percentage which I mentioned for excise is on the RSP, or what we call it RSP here is retail selling price, but it is in fact the MRP. So this 100% is on the value which it was intended to be sold. Let's say I am selling, it's not on what I am selling to my retailer for onward selling. It is on the price that it will be on the shelf. So here there are these, the Vishal Meka Mata I can just think of, but there will be, I'm assuming, the stores where we are going, modern trade stores, there we see something on the shelf and that has a price to it, right? That is a 10 dirham price. So when I'm picking up a 10 dirham can of Coke or 10 dirham 200, 50% of that will be excise already. So the excise rates are on the RSP, inbuilt in the RSP. So after the excise per duty, the RSP will be displayed. So that's how it is there. It has nothing in this excise here. Once you register a product, you also register what will be the RSP of this product, and on that you pay the percentages there. So in my example, it will be 33.3% of the RSP if the rate is 50. Yeah.
Okay. So third question to you is, please elaborate the input VAT credit for a person running a business of restaurant, especially with regard to purchase of some basic inputs like milk, vegetables from this local supermarket.
So yes, again I can. So if a person is running a restaurant and he is registered for VAT, whatever customers come to him in whichever emirate he is operating that restaurant, he has to charge VAT on his sales. Now, when he is doing a business, he is buying from a local supermarket milk and gas or whatever rent he's paying for that and whatever things he's doing. He will be able to take the credit of all these expenses, provided these expenses are these credits are in relation to the business that he's doing, which is of a restaurant. There could be some things. Let's say he's a restaurant, but let's say he bought some packet of chips or something from for the staff, for the restaurant staff, or he bought a cake. He's not into business of cakes, but he bought a cake for the staff or some those kind of pantry items. Those credits will not be eligible. But so whatever purchases he is doing for providing for selling the restaurant, for giving goods, selling goods, that is all subject to he will be able to take the deduction of that credit. So there is no restriction on the number or the limit he can even buy, so long so it is all for the business, he can claim. And here there is no one-to-one mapping that I bought 2 liters of milk and I sold 10 tea or coffees from that. There's no one-to-one mapping that today I'm buying and tomorrow I'm selling. You buy whatever, you sell whenever. That's the simple principle.
Okay. So the fourth question is VAT levied on imports apart from customs duty and excise duty?
Yes, that's again the same questions which I answered. So yes, it is levied on all imports apart from customs and excise. So VAT is the third tax which, when you're importing, all three will be levied if it is an excisable products. If it is not for all the products, so mostly it is only custom duties and VAT. Only when you're importing tobacco, energy drinks, sweetened drinks, and this colas and fantas and all those, then you'll be able to, you'll see all the three duties coming together.
Next is they need to know about the return filing and tax audit. What about return filing and tax audit?
So I think this would be I have answered it. Maybe they would have asked it before I was came to the topic. So this was all about the tax audit, how the tax audits happen. The FTA gives you a notice. You have to give the data within 55 days. They see all the data. This is the question they ask. The data needs to be given line by line, transaction wise transaction. They see sample documents and then they give a notice that these are the issues, resolve or we will penalize you. In that case, there's no mandatory audit. The authorities do a risk-based audit. That's one thing I would like to add. For the return filing for VAT, it's quarterly or monthly depending on your tax period. When I am registering, and within 28 days from the tax period end, I file my tax return for VAT. For excise, it is monthly 15th. If someone is excisable, they have to file their VAT returns. Also excise return, sorry. And yeah, these are the two. And customs, there's no return. There's customs, it's just you pay at the time when you're importing the goods. I hope that is now it will be making it'll be clear.
How is the assessment procedure there and the time limits?
So the assessment procedure is basically the procedure is this. What I've explained to you again, that this is how authorities, with there's again they do a risk-based approach. They don't. They don't necessarily have to audit 5 companies in 1 year. The time limit the FTA, the authority, has is in 5 years. They will they have to audit. For example, now we are in the 5th year of VAT. If this year they don't audit a company, for example, then next year they'll not be able to audit 2018 data. So because the period of limitation is 5 years. So they will audit from 2019, 2020, 21, and so on, unless of course that's discover some fraudulent intentions where the time limit extends. However, this is as a normal, the time limit which FTA, the tax authority, has to audit is only 5 years. So yes, in the coming years we are seeing, or we are, because of COVID, 1 year got lost, but we are expecting to see a lot of audits from the authorities. In last year itself, beginning 2021, they initiated I think 1800 audits. Just they gave notices, and now, even though the time limit on taxpayers is to revert within 5 days, give answers, everything on point, but the problem, or the what we have seen as a good or a bad thing again, is the authorities. They take a lot of time to close one audit. So we have one audit which is started in 2020. Still, it's not completed yet. Because there, see again, my only limited point here is VAT law is at a very very nascent stage here. They will also evolve. The authorities are also growing and they're hiring, and they're also one. What we've heard recently is also they're also giving out for these audit jobs. They might outsource in the future to CA firms, or the professional firms. I will not say CA firms here, but yeah, mostly they are CA firms. So they'll outsource these audits also to them in the years to come. Maybe they've already outsourced the debt collection. They've already outsourced some of the verification to some agencies already. They've done that. So audits also might be a good scope, because they also will reach a wider audience, and they'll also be able to audit as many people as they can. Yeah, so that is around the time frame of the audit. They can complete it whenever, but they have 5 years to see the data in terms of period of limitations.
Is the assessment faceless or in person with the FTA?
So all audits are already. So what used to be happen is earlier in 2018 and 2018, I've just seen one, so I cannot comment more. But 2019, whatever audits I've seen, they're all face to face. Like you don't need to go to the authorities; they will come to you for one visit. So a visit of the price they will do. But once or twice or thrice they will come for discussions and taking notes, but the work which they do is all on their end, and you cannot go. You can, I mean, that's a special thing, but they don't invite you for sitting there with documents, like how I've seen in GST, in service tax, or these refunds in India, where you take all the documents and go to the authorities, sit with them. That is not there. They will it's all virtual and all online. The only thing, 3 or 4 visits they will do for understanding your business, identifying some issues, and so on.
Can an Indian chartered accountant practice in UAE?
Yes, very well. I'm an Indian chartered accountant and I'm practicing in UAE. So, basically I work for a consulting firm only here, which is, the MD of our company is an Indian chartered accountant, and I think we had a CA firm. It's an audit firm. So there are mostly all the audit firms. So yes, there are the big fours, then there are tier 2 firms, and then there are multiple other firms. They're all, one is audit practice, and then the second is consulting practices. So whenever Indian CA wants to come here, a lot of our I've seen a lot of my friends opening up only a branch. Like I think the chapter allows for that. An Indian CA firm can open a foreign branch. They have to keep one CA, responsible CA for that, one person, so that they can very well do, and laws of UAE also do allow that. And when VAT was new, and with the advent of now corporate tax coming, I'm very sure that a lot of people are going to set up practice here. So it's very well doable, and yes, I hope that clarifies.
That's all for today. Thank you so much, sir. Sir Winston Churchill has rightly said for you, an optimistic sees an opportunity in every difficulty. Now, I would request respectable secretary of Jabalpur branch of CIRC of IICAI, come and say a word of thanks to CA Pushkar Sundar.
Thank you, ma'am. Am I audible? Am I audible?
Yes, you are.
Yeah. Thank you, ma'am. I'd like to thank the eminent speaker for today, C. Pushkar Kundraji, for guiding us in professional opportunities for CAs in UAE. सर जो है आपने जो है इंडिया के बाहर तक हम लोगों को ले गए और UAE के बारे में बताया कि कहाँ कितनी opportunities हैं. I think many more members would like to do practice in UAE and would definitely do the professional work in UAE. Thank you very much. I'd also like to thank the CP committee for organizing such a wonderful event. And finally, I'd like to thank all the delegates for participating in this event. Thank you. Over to ma'am.
Thank you, Ashish sir. Am I audible, sir?
Yes.
Okay, sir. Sir, it's my pleasure to introduce our next speaker. We are blessed to have with us, I will just take a minute, CA PS Prabhakarji. Welcome to the seminar, sir. He's a chartered accountant. He has over 40 years of post-qualification experience, out of which 11 years in Indian public sector insurance industry, 7 years in Gulf Insurance and Investment Company as Group CFO, and presently in 23rd year in active professional practice. He is co-opted member in the non-standing committee of Banking, Insurance and Pension of the Institute of Chartered Accountants of India, New Delhi, for the 7th annual term. He was a member in IRDAI's Standing Committee on Accounting Issues. He have been invited as a speaker in many forums, including ICSI, LIBA, Lions Club, Revenue Bar Association, etc. He is the president, Society of Auditors, Chennai, and organization of 90 years standing. Have been a prolific writer on various issues concerning profession on topics such as insurance, IFRS, taxation, multinational accounting firms, etc. Please welcome CAPS Prabhakarji.
Thank you very much, Dilbag Kaur. It's a great pleasure for me to be. Am I audible? Hello? Am I audible?
Yes, sir, you are, sir.
Thank you. Thank you very much, CA Dilbag Kaur, for a very generous introduction. And I also thank the Jabalpur branch of the Central India Regional Council, as well as the CPE Committee of the Institute of Chartered Accountants of India for giving me this opportunity to address members on a topic which is close to my heart, basically professional opportunities in the insurance sector for chartered accountants. I will share my presentation. I will probably not try to speak on the insurance industry's importance as well as of the professional opportunities that are available to the chartered accountants. And I will probably split it into three. Now, one, professional opportunities that exist even today. The professional opportunities that are likely to come our way very soon. And the third is, again, the professional opportunities that are available for the investment sector of insurance industry. There are three things I'm going to be talking about. But basically, insurance industry's importance is something that people will have to know about, because people, in general, chartered accountants, I have seen, they do not care much about the insurance industry, because they think it is a very small industry. It's only 50 plus companies in the country, and how many people can get audits and all that. Everybody looks for statutory audits. Everybody looks for internal audits. It may not be available at all, because there are several big firms of chartered accountants who are having insurance verticals also. So it is easy for them to get more assignments in the insurance industry. But it is not impossible for chartered accountants, mid-sized firms of chartered accountants, and also even individual practitioners to get the kind of opportunities that one can have. Also, I was talking about the three-way split, but I'm also going to be talking about how the insurance knowledge or the domain expertise in insurance can be used by chartered accountants to even further their own clients' interest and also to, explore opportunities even without going to the insurance industry. But the knowledge of insurance will probably propel more opportunities. The insurance industry is next only to the banking industry, financial sector, the company. Well, the protects it. In the Institute of Chartered Accountants of India, we were having banking committee separately, insurance committee separately. They thought it fit to combine both the sectors, both insurance, banking, and also added pension. So it is now a committee on banking, insurance, and pension, single committee that deals with all these three financial sector industries. One of the most important barometer of economy, because you will know the one of the most important barometer is banking. And as I was mentioning to you, it is only the banking. It is in India it's a debt-driven economy. Basically, it's not an equity-driven economy like most of the Western nations are. So when the banking sector only gives loans to the industry, and industries create wealth out of the loan that is given. So, and that wealth has to be protected. And that is the reason why everywhere you go to a bank for getting a loan, they will simply ask you to insure and also to file the insurance papers with them. It is necessary for them because it is their own money they are protecting. So in the process, by protection of insurance, by the risk management, what they do is the nation building is protected. So it aids in national building process. And you have a lot of insurance has come a circle. It used to be, we had several private insurance companies earlier. 100 companies were there. I'm talking about prior to nationalization of insurance companies. Post the nationalization of life insurance company, and also in 1971, the privatization of general insurance industry, when we had only one company called LIC, which was the monopoly for life insurance, and there were 4 insurance companies that were created: United India Insurance, New India Assurance, National Insurance, and Oriental Insurance. These public sector companies were formed for running the general insurance business of the country. And this whole thing came back once again to the privatization. We had in the year 1999-2000, we opened up the insurance industry. So the IRDAI was formed. So we also gave license to the private insurance companies. And today you have many private companies that are competing with the public sector companies. And you have more than about 60 companies today that are operating both in the life sector and also in the non-life sector. What are the recent trends in the business? You have bank assurances. Most of the banks are tied up with insurance companies to do something or the other. Mostly they are selling insurance products, and many banks have found out this as a profitable and important, significant vertical in their banking operations. You have business tie-ups with other companies. The insurance companies are tying up with several companies. They're having tie-ups with not necessarily bank companies, even other financial sector companies. You have corporate agencies, which was not available earlier. The intermediary business was done only by individual agents. The corporate agency culture was created only after the advent of IRDA. You have standalone health insurance companies. Today, we have more than 6 standalone health insurance companies which are only concentrating on health insurance. Was perceived to be, not a profit-making business once upon a time. But then there were people who had the courage to start as health insurance companies, and now more than 6 companies are there transacting only health insurance. You have specialized offices today. You have motor-specific offices, doing only motor insurance business. We have rural doing rural business, and we have what is called micro offices, and you have also sales manager stations. All these things are recent trends in the business, which was not there earlier. In an insurance industry, in an insurance company, you have major twin functions. There are 2 functions. One is the insurance function, basically the life and the non. That is a core: underwriting, claims, and reinsurance. All these things are done in the insurance business, both life and non-life. If you look at insurance business, we have what is called underwriting, which is nothing but premium procurement. The term underwriting is a very interesting term. If you look at basically the London Lloyds, there was one called Edward Lloyd who had a tea company, a small tea in Thames Street, and which was the hub for the people who were coming sailors, because that was a place from the river Thames they were taking their boats and they joined their ships and they were carrying out voyages. And Edward Lloyd at that point of time, he used to have a lot of sailors as his clients and customers who used to come for a cup of tea. And all that they were talking about was the various losses that they have had incurred. For example, somebody will say that their voyage was marred by the adverse weather conditions and the cargo was lost. Or somebody will say there were human lives losses also because of some pirates. So many things were happening. The perils of the sea were always talked about in that tea shop. So Edward Lloyd thought, why don't we do something good for these people, for these sailors who seem to have a lot of losses all the time. So what he said was, I'm going to start some kind of a system by which I will hang a paper in the notice board of my tea shop as to who is going to be sailing on what date, to which country or to which place. And he is going to carry out so many things. But those people who would like to, who are interested in contributing for his losses, in case he incurs losses, they can probably write their name and also put a figure around that. If that particular voyage ends in a loss, this particular paper will come out and people will be contributing money so that one of their community get benefited and the losses will be shared by. This is the starting point of insurance. In fact, if you look at insurance, marine insurance is supposed to be the mother of insurances. And the marine insurance started in this version. And that is the reason why Lloyds of London even now is proudly standing as one insurance maker. And you look at this concept of paper in which a small piece of paper in which the names were written. And people were writing their names. They're putting a figure and underneath they were writing their names. So that is the reason why the name underwriting even started. That was the origin of the word underwriting. And even today, even in reinsurance parlance, they still call even the reinsurance agreements or documents, even though it may run into several hundred pages in a spiral bound, it is still called a slip. And the people who are the members of the Lloyds are still called the names. They are not called partners. They are not called directors. They are not called anybody. They are called names. So the words, the phrases called names, underwriting, slip, and all that, they have their origin to this Edward Lloyd's tea shop. Now, this is the basic insurance business. And another most important function of an insurance company is you will have to keep investing. All surplus funds of the insurance company will also have to be always kept invested to ensure safety, liquidity, returns, and asset liability matching. This asset liability matching is very important in respect of life insurance companies because life insurance policies are issued for longer terms. And when you are issuing policies for longer term, you will definitely know, apart from the death claims, you can easily calculate your maturity claims or the amounts that you will have to pay in a particular year, so that you can also create assets which will mature in that particular year, so that there will be an asset liability matching. This is one of the most important concepts that you can see in the life insurance business. So the insurance business as such, it will produces potential liabilities which need to be kept as reserves to be represented as investment assets. Now you will have in a life insurance company, you have to have a life fund. the life fund is calculated by an actuarial calculation, which will probably reflect the potential liability. In general insurance business, you have what is called an unexpired risk reserve as well as outstanding claims. Both of them are the liabilities for which the necessary assets will have to be kept. Such investments will consist of policyholders representing reserves, but also basically such investments are consisting of kept as invest about how safely, to what extent our chartered accountants are going to be being used by the IRDA for this particular function is something that we will be discussing a little later. Insurance Regulatory Authority of India, it was formed in the year 1999 by an IRDAI Act, and they have been coming out with regulations. One of the first ever chairman of IRDAI was Sri Rangachari, who was our own member, who became a CBDT chairman, and subsequently, on the retirement as a CBDT chairman, he was appointed as IRDA chairman, and he was the person who came out with initial regulations on accounting, investments, solvency margin, reinsurance, etc. Today, you have more than 60 regulations governing almost every aspect of governance, every aspect of an insurance company functioning, which means starting from accounting to issuance of capital, including to social and rural sector obligations. So as I was mentioning to you, there are opportunities that are propelled by regulations. There are opportunities that are mandated by regulations. And there are opportunities that need to be created also. So, in fact, if you look at regulations, the more and more complicated and more demanding regulations are, you can definitely say that there are more opportunities arise. We were listening with rapt attention about these opportunities that are available in UAE taxation in our earlier session. So we will have to understand why he was mentioning why opportunities, and the opportunities are arising because of the complications that are going to be arising in the taxation regime. Everywhere you start taxation, complications are not going to be far behind. If we have seen in India, every year we are getting more and more complicated, more and more opportunities for chartered accountants. Now let us look at operational audits. I'm not going to be talking much about the statutory audit, though it is a mandatory, because insurance company has to be a company under the Companies Act. So we will know that as statutory auditors, we know, as chartered accountants, we know that statutory auditors have to be conducted in terms of Section 143, where we are talking about only a true and fair aspect of the financials has to be attained. But I will tell you what is difficult. What is the difficulty in attesting of an insurance company's balance sheet? Next slide. But the attestation is to the shareholders. Even though the attestation is to the shareholders, basically it is only the MCA that should get concerned about it, because Companies Act has already mandated about the statutory audit format, everything. But whereas an IRDA, as far as insurance companies are concerned, IRDA's financial regulations not only mandating the formats, but it is also mandating the statutory auditor's report format. So it also talks about report, about which also I will talk to you. But basically, statutory audit is the attestation that is addressed to the shareholders of the company. If you are going to have an assurance to the management, you have to have what is called an internal audit mechanism to check on the operational efficiency of the company's shop floor operations. And of course, the concurrent audit, whether it is holistic concurrent audit or segmented in concurrent audit. Now, the next thing is, I will probably talk, during the final half an hour, because you have what is called regulator mandate audits. I was telling you the difficulty that you will be facing in the audit of an insurance company. Basically, chartered accountants have to certify the balance sheet as true and fair. That's what I was mentioning. And every balance sheet that you sign, you are also signing your own death warrant if the balance sheet is not true and fair. I'm talking about a death warrant in a euphemistical terminology, because basically you are subjected to a very rigorous disciplinary mechanism of Institute of Chartered Accountants of India, especially if you're going to sign a balance insurance company size where money is involved. Then there is always trace of difficulties, because a balance sheet of an insurance company has an inherent mismatch. Asset side of the balance sheet are all facts. You have what is called cash and bank balance. You have investments. You have real estate properties. All are facts, because all of them are mentioned either they are captured on their cost basis. They are all facts. Whereas on the liability side, you have what is called estimates. You have outstanding claims estimate. You have unexpired risk reserve, which also is an estimate. So when assets are facts, liabilities are estimates, facts are falseless, estimates can be erroneous. That is the first inherent mismatch of an insurance company's balance sheet. Accountants do control the asset side. Anyway, you have to, all the asset side of the balance sheet, if you look at, everything is controlled by the accountants. Whereas in the liability side, when it is a URR, which is basically unexpired risk reserve, or outstanding claims premium, which will be inclusive of what is called IBNR, incurred but not reported, about which also I will probably talk to you a little bit. All these things are calculated by the actuaries. So it is only the actuaries mandate the estimates the liability side. So you are not going to certify only the asset side. You are going to certify also the liability side, on which you have little control. From fixed assets to current assets to investments, the whole asset side of the balance sheet are physically verifiable. But on the liability side, estimates are susceptible to errors, however scientifically made. Now, this is the inherent mismatch of a balance sheet of an insurance company. Now, I will talk to you on some of the audits. I am not going to be talking about the statutory audit, which are, of course, necessary, mandated by the law, and all these things are already taken care of. Every insurance company will have to have a statutory auditor, one or two perhaps, and they will. Most of the insurance companies, the managements also pick up their, basically either a banking group or an industrial group starts an insurance company, and they probably have their own comfort zone in terms of selecting the auditors. But every auditor of an insurance company need not be having domain expertise. I am going to be again and again insisting on domain expertise and getting knowledge on insurance, because it is only by knowledge augmentation we can even hope to get more opportunities in the insurance. Now, let me go to individual, types of audit that probably we may have more in the future. Revenue auditing. Because as I was mentioning to you, a balance sheet holistically to be audited, because there are thousands and thousands of transactions in an insurance company every year. Not because audit, especially when the insurance operations are conducted pan-India. Let us go to the revenue auditing. If you are going to go individual segment-wise, there are insurance companies are going to be appointing people. They are going to be engaging chartered accountants to do these kinds of segment-wise auditing, at least for some specific years, because they will probably be needing them. The only source of revenue is the premium income. And when you're talking about premium income collection, you have a specific regulation called manner of receipt of premium. There are only three methods by which premium can be collected according to the Insurance Act. The Insurance Act talks about Section 64 VB of the Insurance Act talks about either you can collect cash, or you have a bank guarantee, or you have a premium deposit. The only thing that I want to tell you is, I will probably be talking about 64 VB also, but the whole idea is insurance business is not available on credit in India. You cannot say, please give me an insurance policy today, I will come and pay the money tomorrow. It's not possible. Now, why it is not possible? Because the insurance covers an uncertainty. Once they commit an insurance for you, from the moment they sign the balance sheet, they are on risk. And if they have not collected your money, which means they are on risk without even collecting the money. That is not possible. So anyway, you have to have a cash flow necessary to reconcile the premium cash control account. Once you have three methods of premium collection called cash, bank guarantee, and premium deposit, individual control accounts will have to be there, and they will have to have a cash flow preparation for this. There are areas like check dishonor, delay in collections. All these issues are there in the revenue auditing. All these things, especially bank reconciliation statement, audit trail of fund movement. All these things are very necessary in the revenue accounting of an insurance company, and these things are not in detail looked at by a chartered accountant doing a statutory audit. So sooner or later, we will have insurance companies asking for people to do only revenue auditing. I was mentioning about 64BB. I think I have already mentioned this. This is the only industry where credit selling is barred by statute. Because it is not possible to do, as I was mentioning, to buy insurance today, pay tomorrow is not possible. Not even in life insurance, not in general insurance. So, which means Section 64BB mandates either you have to have a cash upfront, or you have to give a bank guarantee, or you have to keep a deposit. Why there is a cash deposit? There are cases where frequent insurance needs may be there for a person who actually, say, for example, exports or who does transit covers. So he keeps on sending covers. It is not possible for him to go to insurance company, to rush you into insurance company, or to log on to insurance company and take policies individually, policy wise. What happens is he keeps a deposit and he keeps what is issuing a cover note. The insurance company gives him a cover note for the purpose of convenience, and he keeps issuing cover notes. And so the money that is already available with the insurance company will cover the risks that the insurance company takes on a minute-to-minute basis. So now, everywhere, whenever there is a claim is passed, one important certification that is necessary from the underwriting side is the claim that the 64BB has been complied with. This compliance certification is very necessary before the payment of any claims. So this compliance certification also is something, whether they are doing the correct certification or not, is something that is verified by an audit. That probably will also have to happen. Bank guarantees and cash deposits accounts also have to be verified. Let me go to the underwriting area. Each company has their own underwriting policy and underwriting norms. So whether the management has got an specific underwriting policy within the overall parameter of an insurance, underwriting norms, we will have to find out whether it is possible for a company to find out whether there are any operational deficiencies are there or not, especially in the area officers or branch officers, only if test checks are to be done, or even sometimes in-test checks are done. So these test checks are done, which means you will have to go with every individual policy document. You have to look at the proposal form. You will have to look at the physical policy and basic underwriting papers to find out whether all the papers have been collected, whether KYC norms have been, are incorporated properly, whether warranties and conditions and bank interest clauses are incorporated in the policy or not. All these things will have to be verified by somebody, and that somebody again will have to be only auditors, who will probably not be the statutory auditors, but who will probably be the concurrent auditor of a particular branch or of a particular location. Because wrong or incorrect underwriting could lead to wrong claim payments and possible litigations also, which will probably span for several years and also cost the company substantially. The next is procurement cost. One of the major expenses of an insurance company is the procurement cost, which means basically commission. Commission payable to the agents, commission payable to the corporate agents, commission payable to the brokers, commission payable in terms of referral fees, and all these things, several methods of remunerating the person who brings the business. Insurance is a push business. It is not a pull business. It is an insurance policy has to be sold. It is never eagerly bought. People are not very happy to buy insurance companies. People are saying that I have paid for an insurance company. Even those people who are paying car insurance premium, they feel, oh my God, I bought a car and I have purchased a 20 lakh worth of car, and I have to pay an insurance premium of 20,000 rupees, and there is no accident, no claim. My 20,000 rupees is a loss. But what people don't realize is 20,000 rupees is not spent for a possible claim. 20,000 rupees for the possible. Example, a car is bought and 20,000 rupees premium is paid, and suppose somebody, the car driver hits somebody and there is a damage or damage to a physical person also, or there is going to be any injury claim or even a death claim, will come on the amount of payment that needs to be paid as a compensation will be very huge, and if it is not for insurance, this cannot be borne by any individual. That kind of Hello? Devan? Devan,
Yes, sir, we can see you.
was I disturbed for some time?
Yes, sir, for just 2-3 seconds.
Okay, very good. Okay. Now my screen is clear?
Yes, sir, yes, you are visible.
Thank you. Okay. Now you have what is called corporate agencies and brokers and all that. There are limits that are fixed by the IRDA in terms of agency commission, and in insurance, the rebating of the premium is statutorily barred. So it is not possible for you to do some kind of rebating or any kind of indirect method by which you will remunerate the commissioner brokers. So in these cases, the procurement cost, sometimes it ranges even up to 25 to 30% of an insurance premium, which is a heavy chunk of the premium receipt. Now, in this case, the auditors will have to be very vigilant in terms of looking at whether the correct amount of commissions are paid, whether any other amount is being paid. There are so many methods by which these people pay, insurance companies pay, because they will have to get more business. They will have to have, they are very hugely competitive. So that is the reason why it is, these things are have to be checked very vigorously and intensely. So auditors have enormous amount of work in this. 1 second. Earlier, when there was only public star companies, we had the huge problem of Binami agents, because every insurance company's employee will have his own some other relative to be called as an agent, and they will bring every business that even a walk-in business, they will put an agency code and take agency commission. That's all been stopped by IRDA because of the fact that they have brought in very strict regime of agency commission. They have to pass an examination and they will have to get a license, duly licensed by the IRDA. And also, they will they subject themselves to a very strict KYC norms. Now, another important aspect of expenditure of the insurance companies or the outgo is the claims. Claims outgo are the highest expense for any insurance company. In non-life sector, the incurred claims ratio is as high as 86% these days. Incurred claims ratio is something called claims paid plus outstanding claims at the end of the year. As I was mentioning to you, outstanding claims is something that is estimated for those claims that have been intimated for which they have not yet paid before the year end. It is like an outstanding expense only. So you have to provide for outstanding expenses, not only for those claims that have been intimated, even for those claims that have not been intimated. Also, there are claims incurred but not reported. That is why called IBNR, incurred but not reported. Incurred but not enough reported. There are two things are there. One is IBNR, another is IBNER. Both IBNR and IBNER will have to be added to the actual claims paid, and of course, you will have to deduct what is the opening balance of the outstanding claims. What is called as expressed as a ratio to the net premium income is called the net incurred claims ratio of 86%. You may wonder, you are talking about 30% expenses of management, commission, expenses management to the extent of about 27%, 86% as towards the claims ratio, where is the insurance company making money? The insurance companies are trying to reduce all these things, and they are trying. That is why the investment becomes very, very important, which I will probably be coming a little later. So the investment income of an insurance company is extremely important, because most of the insurance companies will not be able to make money in the core insurance area. So the procurement expenses and management expenses, that is why they have got limits on expenses of management. Also, as I was mentioning to you, there are limits for procurement expenses. There are also limits for management expenses, because under the Insurance Act itself, they cannot have management expenses beyond a particular level. Because once their management expenses limits are not there, the insurance companies, especially private insurance companies, will probably be very extravagant in their expenditure. So in order to ensure that the insurers are not extravagant in their expenses, management expenses are statutorily limited. Again, this is the only industry where management expenses are statutorily limited. So what happens is, basically what you need to have is efficiency audit in these major areas called claims as well as operational expenses, which include both procurement expenses and management expenses. So the managements will have to be suggested sooner or later. They will have to engage professionals to do efficiency audit in these areas. Reinsurance is a very, very tough and complex and technical area. Basically, reinsurance is something that the companies take, they accept your risk, but these people pass on their risk to reinsurance companies, because it is not possible for them to retain all the risks themselves. For example, if an insurance company insures, let us assume that there is one area. Let us assume, say for example, Connaught Place in Delhi. Connaught Place in Delhi, all the shops are coming to an insurance company for insuring their shops for various policies, burglary policy, let us assume. Okay, every Connaught Place policy shop comes to an insurance company, and they, for example, they insure their products. Say, for example, 10 lakhs, and somebody for 20 lakhs, somebody for 30 lakhs, somebody for a few crores. And suppose you add up all the sum insured, it will probably come to something close to, say, 1,500 crores. But which means, if they are going to have, there is going to be a major fire that is going to break out, and the Connaught Place is going to be gutted completely, let's assume the insurance company's loss will be 1,500, which they may not be able to pay. So what they will do is, they will bundle all their risks, and these risks are bundled and reinsured with reinsurance companies with various countries and various companies. That this will be a policy, reinsurance policy, and they will have to have also an reinsurance program, which has to be approved by the IRDA. Whether these policies are whether these programs are as per the reinsurance policies or as per the reinsurance regulations promulgated by IRDA, they will also have to be examined. And treaties, the treaty insurance company, there are the treaties which basically insurance companies agree with another insurance companies. This is called, the agreements are called treaties. These treaties also will have to be examined. And you have something called bordereau from RI companies. Basically, the statements that are given to the reinsurance companies about premium, about the reinsurance commission, and the claim. And with the RI companies and brokers, the whole statement is known as bordereau. This bordereau will be prepared quarter-wise for treaties, each individual RI company-wise, each underwriting year-wise. This will be prepared. And this is a very complex calculations. And these things will have to be verified. And to verify themselves, these things also, it requires enormous amount of knowledge and about the reinsurance knowledge. So these things will have to also be verified. Quarterly accounts and periodical statements of reinsurance accounts also have to be examined. These things you have to have. Statutory auditors do not have time, especially within the very limited time that is given to them. They cannot do it. And in order to ensure that these things are correctly done, the management, to draw comfort, sooner or later, they will have to have engage people to do this kind of reinsurance. Today, why are they not doing all these things? You can ask, well, sir, these things are already difficult. Why are they not doing already? Again, it is the cost that is creating a problem for them. But the cost benefit analysis will have to be seen by them sooner or later, and they will have that these things are individually audited. Again, in reinsurance, to continue the reinsurance, there is something called a profit commission. Profit commission is a commission. Reinsurance is one business. Between the insurance companies, the reinsurance companies are there. But for every reinsurance business that is done by an insurer to a reinsurer, the reinsurer also pays commission. Not only he pays commission, on a holistic level, when the year is ended, they will have to find out how much premium I have collected from this insurer, how much claims he has claimed it from me, how much commission I have paid him. In case I have still made a profit, there will be an agreement to even share the profit with the regular insurer, which means this is called a profit commission. This is available. This is something that you can see, one very unique thing that you can see only in insurance industry, nowhere else. So I was mentioning to you about the reinsurance and reinsurance reconciliations and quarterly accounts and all that. But where do you go to reinsurer? To which company? You cannot go and have reinsurance company. Reinsurance with every country. For example, there are countries in Pakistan, there are countries in Afghanistan, there are some countries in Tajikistan. All those companies are there. Is it possible for you to go and reinsurance? You reinsure your risks with them. You will, because you will also have to find whether the company with which I am going to reinsurance, where I am doing reinsurance, whether it is a sound reinsurance companies are rated. So in the international market, the rating is very important. So the rating of an insurance company in the international market is so significant, and that rating is dependent on the auditor's certifications. So once you become an insurance company as an insurance company, if you want to accept risks from insurers or reinsurers inwards also, you also need to get rated. Rating is very important. Today, in the reinsurance regulations of IRDA, they have specifically mentioned that it has to be AAA plus, or it has to be done. This has to be this kind of a rating, and all that has to be done. How do you get a rating? You get a rating only on the basis of your accounts, the quality of accounts, the quality of governance, the quality of the disclosures, and these things are very important. The auditors are there, and statutory auditors can derive comfort only if there are going to be auditors, audits of specific segments, and these people have comfort on from there. The next is ITGC. Now you will have to look at the fact that there was a time when I was working in an insurance company long time back, that is between 1980 and 1991, 11 years I was working for a company called United India Insurance Company in Chennai. But we were doing everything manual. Computers were not introduced in a big way till about 1988 or so, when we had only what is called personal computers to start with. But today, every company has end-to-end integrated software for the entire module, underwriting module or claims module, and they also have integrated all the modules from underwriting to claims to reinsurance to even to back office. Now, these things are done, and you need to have basically a statutory auditor who knows general controls of the information technology. So, but this ITGC audit is not possibly done by a chartered accountant who is doing the statutory audit, but a statutory auditor can still insist that he can have comfort only if a comprehensive ITGC audit has been done and certification is given to him. Because statutory auditors are outsourcing this work to CA firms. Even today, even when we were the statutory auditors for some insurance companies, we insisted that this was ITGC, because we do not know the software. We do not go inside the software and see whether the software has been programmed properly in accordance with the regulations that have been given. So basically, not only the regulatory aspects of the matters will have to be programmed properly, the scope also should include data security, business continuity planning, and also disaster recovery. All these things. Today, you have online marketing, online sales, web aggregation, everything is there. So all these things have to be done. Everything is done by computers. Everything is done by systems. So a proper system audit has to be done. And this is again, for those people who have done CISA or ESA, this is again a very huge opportunity from insurance companies, especially insurance companies have gone for significant computerization. There is one more thing which I was talking to you as a passing reference in the beginning. Every statute, I was mentioning to you, insurance companies are the only ones, even though subjected to audit, statutory audit by mandate of the Companies Act, it is the Insurance Regulatory Development Authority that has mandated the what is called the format of the accounts as well as the format of the audit report. In the audit report, they've also mentioned, the financial regulations also mentioned that all the companies will have to submit something called a management report. This management report, if you look at, it is a part of the annual reporting requirement. This annual report, if you look at the management report, if you see, the management report has to, has to mention many confirmations, certifications, disclosures, and declarations by the management, and also it should include a comprehensive responsibility statement by the management itself. And what is more important is the statutory auditor is mandated to certify that they have gone through this management report and that whatever mentioned in the management report is correct. This is like one more certification that has to be given. If you look at the management report itself, it looks like an audit program by itself, because they are asking for some, it is like almost like a 44 AB report. The mandated management report, as I was mentioned, as I always used to call it, as an audit program itself, because they're asking verification. What is the shareholders and have you paid it starts with the question whether have you paid the license fee to IRDA for the current year? What is your shareholding pattern? What is your solvency margin? What is the overall risk exposure and strategy? What is the aging of claims? Valuation of investments, review of asset quality, performance of investments, review of valuation of loans, agents' balances, outstanding. Not a single aspect of governance, single aspect of financial has been left behind. They've asked about sundry debtors and several items specified in other accounts. They will say all these things. Only if you look at this management report itself, even to find out whether the management report has been done correctly or not, which the statutory auditor will have to certify, it is required a statutory auditor will have to outsource this particular work to another statutory audit, to another chartered accountant to get these things done, and as an ongoing exercise, because it is not possible to do only at the year end, because the management report does not talk about a 31st March. It talks about over the year situation. Now, as I was mentioning, IRDA regulations more than 6. I have talked about all these audits which are likely to come our way because they are all propelled by the regulations. The regulations are so strict in IRDA, in insurance industry, and you need to have, and the more and more complicated the regulations are, the IRDA itself is making it more complicated, and IRDA is almost inviting these companies to subject themselves for intense scrutiny in these areas. For example, areas like policyholders protection, capital adequacy norms, obligations to rural and social sectors, expenses of management, advertisements. You will be surprised that even advertisements and disclosures by an insurance company will have to get IRDA's permission. If you have looked at many commercials of insurance companies, either in the billboard or in the TV commercials, you will probably have a small, what is called a small sentence that is you can find. Like, for example, if you see cigarette advertisements, you will say cigarette smoking is injurious to health. Like that, if you look at insurance companies' insurance advertisement, you will see insurance is a subject matter of solicitation. This means the reader of the advertisement or the person who sees the advertisement in either in the print media or the visual media, he will have to know that it is the insurance that is being sold and nothing else. Because normally what happens is you can see a lot of advertisements which are called teaser advertisements. They don't know. You will not even know what is that they are advertising for. They will give you a challenge to your intellect to find out what am I advertising. For example, 3 days they will give an advertisement in the newspaper, first page, same page, something they will say, and the fourth day only, they will say what the product they are advertising for. Those things, those gimmicks are not possible by any insurance company, because you will have to get the advertisement and disclosures also audited. So brokers, agents, third-party administrators, for example, in medical claims, you have to have third-party administrators, web aggregators, like for example, your policybazaar.com and all that. So all these things insurance companies do. IRDA also has its own inspection teams. IRDA inspection teams are undertaken from the regulatory perspective. There will not be a comprehensive mechanism to check on the compliance for IRDA's regulations. So what happens is these IRDA in fact, today IRDA also is not strengthened enough to conduct audits, because we are having more than 57 companies or 63 companies today, out of which 34 companies are life and 24 is general, and 6 what is called your health insurance companies, 2 specialized companies, and 4 or 5 reinsurance companies. You have about 63 companies today, and so it is very difficult for them to do the kind of inspections that they want to do. So sooner or later, they will have to, lean on a chartered accountant. I will tell you why chartered accountant. In fact, we should be very thankful to IRDA in one aspect. IRDA is the only regulator who has in its board permanently ICAI's president as a permanent member. Every president of the Institute of Chartered Accountants of India is always a member of the board of the IRDA. So it is possible for the president to, insist that these things can be given to the institute. These particular should be, according to me, should be leveraged by the Institute of Chartered Accountants of India to get more opportunities in our way. I will talk to you about the other kinds of audit that probably are being done. Forensic auditing. Now you have what is called forensic auditing possibilities are there in insurance companies, because frauds in claims and other areas are not at all uncommon, because it's basically a trust-oriented business. You have many claims that are being fraudulently passed by several insurance companies, claims that are being fraudulently claimed. Okay, now e-commerce frauds are also there. So insurance in India, insurance moral hazard is always an important factor. It is only the CAs who have the investigative skills and technical excellence to conduct such forensic audits. So forensic auditing is again another basic, opportunity that may come under our way. I have talked to you about what are all the opportunities that are propelled by the regulations. Now I am talking about those opportunities that we will have to find for ourselves: risk management and insurance consultancy. I was mentioning to you, insurance. Every chartered accountant who wants to get some knowledge in insurance need not look for an assignment from an insurance company. Business world is wrought with risks. Unless a loss hits a businessman, he never realizes the importance of insurance. So, for example, funder needs on insurances to be tempered. So, for example, a person who gets a loan, he is asked by the banker to take insurance, but they don't even know what happens if they simply link your client who is asking for a huge loan. For example, let us assume that your client is approaching a bank for a huge loan. The banker will say that we will have to get you, we are going to give you a 100 crore loan. You have to get your insurance for 100 crores. Simply they will say that. And they will also link you with an insurance company. The insurance company will send a person who is not very knowledgeable on finance and all that. He will come and give you some policy, and then if there is actually a loss, what will happen is the insurance policy that you would have taken will be short on expectations and probably will not give you the benefit that was intended to be given. So again, what kind of a policy has to be taken, how it has to be taken, to what extent it has to be taken, everything can be done only by a chartered accountant with insurance and banking knowledge. So consultancy to our own clients on risk management, insurance, from motor to stocks, to declaration covers, to fidelity guarantee, to business interruption, to business orders, to Keyman protection, all these policies, it is only a chartered accountant who is actually who can advise his own client to go to insurance, to what extent he needs insurance, why insurance is an expense that is something that is a necessary expense, and how to take maximum insurance at minimum cost. I was mentioning to you, this is a value addition that every chartered accountant can give to their existing clientele, because everyone has insurance needs. For example, I was mentioning to you on the stock policy. I will give you one example. I will not take much time. I think how much more time we have? Anyone there? Hello?
Yes, sir. Yes, sir.
How much time we have?
We're almost, sir, we have to answer queries also. We are having some of the
I'll
queries.
finish it another 10 minutes.
Yes, sir, maximum.
45, I'll finish.
Thank you.
Okay. No, as I was mentioning, I'll give you one simple example. There was a case where there was a clothes merchant who had to stock a lot of clothes. I mean, his merchandise in his godown, which was done in a basement of a building. And what happened was he maximum that he had taken an insurance policy for 6 crores for the year. But what happened was every month of the year, he does not have stocks worth of 6 crores. He may have 2 crores sometimes, he may have 3 crores sometimes, but he may have 12 crores during, say, for example, Diwali time, Ramzan time, Christmas time, and all that. So what happens was, during a Diwali time or particular 1 year, he had a huge, flood loss, and he went to the insurance company and they said, you had stocks worth of 12 crores, but you have an insurance only for 6 crores, which means you have underinsured 50%. And even that 6 crores, they did not give 6 crores. They gave only 50% of the 6 crores because they applied what is called a condition of average. If only he had approached a proper chartered accountant with insurance knowledge, he would have been advised, don't take a cover for 6 crores for the entire year. You take what is called a declaration cover or a floating cover, whereas you will be paying premium only for the actual stock that you are keeping at the month end. So this is something that is possible. And unfortunately, he did not know. The bank did not advise him. The insurance company did not advise him, and he had to suffer a loss. These things are possible consultancy areas that one, insurance knowing chartered accountant can advise to the client. Insurance has been going digital on many fronts. Many insurers are engaged on online sales. So, as I was mentioning to you, it is on the push category and not a pull category. The next generation of the people are going to consume content online, which means the companies are also adapting themselves, because every insurance company is now doing an online sales and all that. They are they are looking new ways to engage with the customers beyond just a static website. So artificial intelligence enabled chats and customer education line are on the order of the day. So these are all the things. And if you look at the influence of IT in the makeover of the industry, the customer expects everything at the click of a mouse, whether it is an online policy or a filing of a claim or even a grievance redressal. So the insurer has to balance between the expectations of the customers, and also the demands of the regulator. And you have to changes that are funneled by the needs. You have today, suddenly de-tariffing comes, suddenly FDA increase comes, everything comes, and you have web aggregators also have come. These things are also coming. Only the chartered accountants, we can become facilitators and consultants in these area of IT makeover of the industry. I'm going to go to the important area called investments. Investments, as I was mentioning, is one of the major functions of an insurance company, and every company is mandated to have an investment policy and an investment committee, etc. Insurance Act, it talks about investments, where you have to invest and where you cannot invest. The life insurance companies or the general insurance companies, they specifically mention where you can invest and where you must not invest, and how much you can invest. There are specific dictates as to your IRDA regulations are also mentioning that limits on types of investments, limits on investee company, investee group, investee industry, prudential exposure norms. Everything is mentioned in the insurance regulation, IRDA regulation, including how do you define your insurance investment policy? How do you constitute your investment committee? All these things are notified in the IRDA regulations. The formats are prescribed also, and valuation of investments, of course, you shall follow the investment regulations. The long before this, the term corporate governance that was propelled by in the Western countries with Enron, which gave rise to Sarbanes-Oxley Act, and here in India we had Nareshchandra Committee. Long before these things happened, the extent prescription on insurance in issues like framing up, approval, periodical review of investment policy, constitution of investment committee with independent directors, etc., happened in the year 2000 itself in the insurance industry. If you look at corporate governance, the taste of corporate governance was given by IRDA to the insurance industry long before SEBI even gave it to the corporate world of India. IRDA set up a working group to comprehensively review the regulatory parameters, and huge impetus was given to the requirement of systems and processes. I'm going to come to a very important subject here on the investment functions in the context of risk management requirements. The concept of front office, mid office, and back offices were fortified. Introduction of internal and concurrent audit by regulatory mandate was mooted. Customers, all the companies were required to undergo a certification process. They wanted to have every insurance company necessarily had to have an IT policy and a standard operating procedure, basic platform covering the ISO 27000 norms. All the companies had to, without exception, were required to undergo a certification process regarding the systems and processes and IT related framework, compliances, etc. Ensured that the companies came with some kind of a preparedness for the regular internal audit companies, and that followed subsequently. Now, why should have such a stringent oversight for insurance investments? You're talking about a huge money at stake. Today, the total figure that in the insurance companies AUM, assets under management, has crossed 50.5 lakh crores. Twice that of the total revenues of the government of India, insurance industry alone. Bulk of it belongs to the policyholders. And the custodian of policyholders is IRDA. Substantial portion of it is in ULIP schemes on the life side. If you look at 30 out of this 50 lakh crores, only one company has an AUM of 35 lakh crores, and that is the company that is going to come to the largest IPO, basically Life Insurance Corporation of India. 35 lakh crores. And all other insurance companies, life insurance companies put together, they have something close to 10 lakh crores, out of which huge amount is done through ULIP method. If ULIP schemes are all, under the ULIP scheme, the investments are made in the capital markets, which are very unpredictable. If not for regulation, the quality of investments might suffer, because the insurers are always looking at reward risk ratio, especially in the privatized scenario, because they are not coming into the government control. Unless the government comes, IRDA comes with very strict regime on investments, the money should be lost. Today, we are happy to say that the IRDA has been so strict, even though there are choking norms for insurance companies, it's a very happy situation that not even one insurance company has gone insolvent in this country so far. Touch wood. Chartered accountants, as I was mentioning to you, we have, as I was mentioning, IRDA being the regulator is not adequately resourced to check on the compliance mechanism. The regulations are aplenty. Regulations are, choking. Regulations are even stifling to a certain extent. And today, insurance companies are regulated or unmandated, very strict auditing regime, both under concurrent audit and under internal audit, because beyond a point they need to have an internal audit, and beyond up to a certain point they need to have a concurrent audit every continuously, and they also have to undergo what is called a risk management audit every 2 years. And chartered accountants, there are very few chartered accountants firms in this country which are equipped to do both concurrent audit and what is called this risk management audit. And these people keep getting the audits again and again by all these companies. There are 50 plus companies, mind you. There are so many opportunities available for the chartered accountants. Even those chartered accountants who people may say, I have never had an insurance, because they are one of the questions that they are asking for empaneling you is, have you done this kind of an audit earlier? If you have never given me an opportunity, how do I do an audit? Because it is not like that. People who have done treasury audits of banks also can again get themselves empaneled for this. And not empaneled by the ARDA, even the companies can approach companies, and there are companies, especially public sector companies, are coming out with tenders on these issues. They are asking for certain basic qualifications, and all these chartered accountants who have even done treasury audits, SEBI related audits, all these things can be bank audits, can also apply for this risk management audit as well as concurrent audit and internal audit for these companies. And IRDA will not come in the way of chartered accountants being appointed, whether they are new or old. So, but today, investment, what has come as mandatory for the investment function, as I was mentioning to you, those specific audits that I have mentioned, these propelled by the regulations, these things could come soon for other functions as well. Chartered accountants with domain knowledge will certainly have knowledge. You have what is called a DIRM course conducted by the Institute of Chartered Accountants of India, or, for example, Associate of Insurance Institute of India, or you have what is called, there is a IIRM in Hyderabad, Indian Institute of Risk Management. There are specific courses that are available to equip yourself in insurance. These things could come in handy. But the chartered accountants should not wait for the basic problem with chartered accountants, if I may say so, we only have acquire need-based knowledge. If something comes today about GST, we will go and read about GST. If something comes under about indirect tax, we go and read about indirect tax. If I get a bank audit, I will go and read about prudential norms. If I get an insurance company, I will go and read about insurance regulations. It is not like that. You should not assume. We cannot expect work to come tomorrow and fail to keep updating our knowledge. We will have to keep updating our knowledge on various investment, various financial sector, like, for example, insurance. So we should keep updating our knowledge on the very important subject of insurance. And let me tell you, there are growing professional opportunities in the insurance arena. Domain expertise augmentation is the need of the hour for chartered accountants. Audit is no more a postmortem. It's a serious exercise to be discharged with utmost responsibility and accountability. And chartered accountants are the only people who are till today have been authorized to do attestation function in this country. And these are all the audits that can be done, especially on the financial sector. We are the people who will be able to perform this work without any kind of a problem, and with the kind of knowledge and expectation of the government. With this, I am completing my presentation. If there are any questions, I'll be happy to take.
Thank you, sir. There is only one query, sir.
Yes.
It is reinsurance on travel to foreign countries. I will elaborate. Even now, the reinsurance on health insurance between countries for treatment is in infant stages. The travel being curtailed due to COVID-19 pandemic, nevertheless, as months pass by, there would be relaxations surely for travel. And in that context, reinsurance on health requires special study. Your views on the same, please.
Can you come again, please? I did not understand.
Yes, sir. The query has been explained further. What is meant here is that if I were to take an Indian healthcare insurance and travel to, say, Dubai or London, is there any requirement of insuring again my health, or I can use the reinsurance policies if any available for the same? So
there is no need for any reinsurance. What happens is, if you take a policy, for example, Star Health Insurance Company or ICICI Prudential or any other general insurance company or a health insurance company for your travel abroad, what is called overseas mediclaim policy is being issued. Okay. Now, all these companies have their own counterparts and their own, hospitals, networked hospitals, or people who facilitate the claims. So all that you need to do is in the policy itself, they give the telephone numbers. For example, if you travel to USA or Canada or UAE, anywhere, they give you the telephone numbers of the person who has to be contacted when there is a health issue when you are traveling abroad. So there is no need for you to go and reinsurance and all that. Reinsurance is only company based. I never deal with the reinsurance company myself as a customer. Okay, so I'm only a customer. So this is something that the policy itself has got details, and all that a person who travels has to contact that particular person in case he's an health issue or in case he needs hospitalization in the country where he is traveling to.
Thank you, sir. If I say P.S. Prabhakarji is a charismatic amalgamation of great experiences of life that have been given.
No, your voice is not clear at all, madam. Please.
Sir, I think mic is on for someone else also.
Okay, I think that's right.
We express our gratitude for your deep and intellectual way of imparting knowledge, which has added a lot in my life. Thank you so much for your words. Now, I would again request our respected Secretary Jabalpur Branch, C. Ashish Agarwalji, to express vote of thanks to our revered speaker, C. P.S. Prabhakarji. C.
Thank you
Ashish.
very much.
Thank you, ma'am. Am I audible, ma'am?
Yes, sir.
Thank you, ma'am. I'd like to thank the eminent speaker, sir, for your vast experience and
Voice is not clear, sir. Voice is not clear.
Hello.
Can you ask others to mute? Yeah, please go ahead, sir.
Sir, I'd like to thank the eminent speaker for today's CPS Prabhakar, sir, for the nice words and for अच्छे से सर इसको डेलिवेशन दिया है vast experience है really shared a vast experience of the insurance sector. We are all very thankful to you for the nice deliberation. So I'd like to also thank the CP committee for conducting this program and all the delegates for this event. Thank you very much. Over to the
Thank you, sir. Work hard in silence and let the success make known. With these words, I request our respected Chairman, Jabalpur Branch, C.A. Madhu Agarwalji, to come forward and for the concluding remarks of the session. C.A. Madhu Agarwalji.
Thank you, ma'am. It has been a wonderful session. And the special thing about this session was that the two topics which we have had today, generally the members are not practicing in those fields. But I think the members who want to diverse to some other fields, it was really very good. It was an eye-opener, I should say, for them that we know कि हाँ ये भी एक opportunity है. मतलब इंडिया के बाहर भी CAs प्रैक्टिस कर सकते हैं और कैसे प्रैक्टिस कर सकते हैं. पुष्कर जी ने इतने अच्छे से समझाया है. So thank you, Pushkar ji. I think some young members who would be listening to it would surely be motivated and would work in this field. Insurance sector के बारे में बहुत सारी चीजें जो I think मतलब I also heard for the first time, and Prabhakar ji has done the job wonderfully. I should say that we had very less queries also in his session. Both the sessions were very good. Thank you, sir, and thank you CP committee for organizing this, for giving Jabalpur branch this opportunity to organize this VCM. Thank you.
Thank you, everyone, also from my side.
CS Nandaji is with us. May I invite him for vote of thanks, please? Woods are lovely, dark and deep, but I have promises to keep. Miles to go before I sleep. Miles to go before I sleep. I request CS Nandaji, if he is present, for the vote of thanks on behalf of CPE Committee of ICAI for today's seminar, please.
I don't think he's there.
He's not there.
Him either. CA Ashish Agarwalji, please coordinate and express vote of thanks again, please.
Pushkarji, I need your presentation. It was very good. I'll
Sure.
send a mail to you.
Sure, sir. I equally enjoyed yours presentation. A lot of so while I do VAT for insurance sector, but your concepts of deep accounting, that I have also learned a lot from your presentation. I kept thinking, what will be the VAT treatment of Bodro? Each and every item in one document and so on. So that is,
Insurance, they have got their own, for policies, they have their own taxation in the UAE. There's a separate taxation.
yeah, there is a IA levy, but now they are VAT and everything, the corporate tax, they'll be subject to equally as well. Yeah.
Thank you.
Mm.
Thank you very much.
Thank you, sir. Thank you so much.
Thank you very much, ma'am.
Thank you all. Yeah, thank you Dilbag also for being a wonderful moderator. Thank you, Mr. Madhu.
Bye-bye.
Bye-bye.
Thank you, CPE, for organizing this seminar. Thank you so much.